Smith alongside Brian Zazi, and this is Yahoo Finance's flagship show, The Morning Brief.
Indeed it is. We are seeing whipsaw action in the pre-market ahead of two big readings for the economy, May's CPI report and the Fed's latest interest rate decision. So let's hit it hard with the three things you need to know this Monday morning as you prep for the trading day. Yahoo Finance's Josh Schaefer, Jared Blickery, and Madison Mills have that analysis you are absolutely craving this Monday morning.
That's right, Sal. A big test for the markets this week. Wednesday will be a double whammy for investors. In the morning, we'll get May's Consumer Price Index report. Wall Street expecting an annual gain of 3.4% on a headline basis and 3.5% on a core basis. That's stripping out the volatile food and energy prices. In the afternoon, Wednesday, we'll get the Fed's latest decision on interest rates. The Fed is expected to hold the benchmark rate steady in a range of 5.25% to 5.5%, as it has done since July of 2023. We'll also get more guidance on the path of possible rate cuts in remarks from Fed Chair Jerome Powell.
And shares of Nvidia ticking slightly lower pre-market as the stock starts to trade on a split-adjusted basis. The stock closed on Friday at $1,208.88, and the AI leader commenced a 10-for-1 stock split, putting the shares around $120 each. This does make shares more affordable for the average investor, but does not affect the value of the company as a whole. And the change comes after Nvidia's market cap surpassed $3 trillion last week. It now sits at $2.97 trillion, just under that milestone figure.
And Apple is kicking off its annual Worldwide Developers Conference today at 10 a.m. Pacific Time, 1 p.m. Eastern, with a keynote by CEO Tim Cook. Now, this is expected to serve as the launch point for the company's big push into generative AI. Apple's marketing chief tweeting that out on X, formerly known as Twitter, this morning, that WWDC will be, quote, absolutely incredible, but you can see there capitalizing the A and the I, alluding to artificial intelligence, of course. Now, Wall Street eagerly watching for announcements that could put Apple on the AI map after a lot of criticism that the tech giant has missed the mark so far. Apple shares are up only around 2% so far this year, trailing behind 5 of the 7 Magnificent 7 stocks, as well as the overall S&P 500.
Let's dive right into our top story and get you set up for the trading day. Here are three big things, not small things, big things to watch in today's session. The big test for the markets this week is coming Wednesday with key inflation data via the CPI index in the morning and the Federal Reserve's decision on interest rates out at 2 p.m. And don't forget that Jerome Powell presser at 2:30 p.m. But dominating investor psyche today is big tech. First, Nvidia stock starts to trade on a split-adjusted basis later this afternoon. All focus will turn to Apple. The company's Worldwide Developers Conference kicks off at 1 p.m. Eastern. Investors are really paying attention to everything Apple has to say about AI. Shauna, I need to know why I need an iPhone 16. What is this device going to do that is going to change my life? Sell me Apple. I mean, you got that quote Madison shared by the CMO. I'm excited about it. I need a new device soon.
Well, yeah, and I think that is the huge question, right? What exactly they're going to announce and the significance of that announcement, whether or not it's going to be enough to get people like you to get the masses out there and upgrade their phone, because we know that many people have been waiting 3 to 4 years on average because they haven't exactly been enticed by the latest rounds of the iPhone 12,
right, Shauna?
The iPhone 14 actually, but that was an upgrade from the iPhone 10, and I simply had to upgrade it because mine stopped working.
Just bring our viewers into our lives, Shauna.
Well, it's a little bit, it's hard for a lot of people, I think, to justify going out there spending $1,200 on a phone that doesn't do a heck of a lot more than their current model, right? But I think an AI could potentially change all this, and this is why the street is so excited about this. You have Wedbush's Dan Ives saying that this could be the most critical announcement coming from Apple within decades. So that's huge.
Yeah, Apple, I think the vibe on the street is that this may finally make Apple an exciting stock again. It's strange to say that here's a company that's selling lots of services, has annual recurring revenue, has Tim Cook still at the helm, still doing amazingly innovative things, but the street hasn't really cared about Apple stock over the past year. What do they care about? They care about Nvidia, they care about AMD, they care about all these hot AI plays, and by and large, what you've seen Apple do is what Apple has done historically, not be the early adopter in certain technologies. Mm-hmm. And as a result, you've seen the stock price trail many other of these AI plays. Who would have thought, Shauna, we'd be sitting here today talking about Nvidia, $3 trillion market cap, basically on par with Apple. 5 years ago, nobody even heard of Nvidia.
Well, yeah, and I think that speaks to the dramatic rise that we've seen within the market on the back of Nvidia, right? Just in terms of the AI hype, the euphoria that has really swept the markets over the last 18 months. And here you have today Nvidia, the 10-for-1 stock split, and you might see on your screen as we had at the top of the show there, Nvidia on track to open the day right around $120 a share. And you're not reading that incorrectly,
no,
but that really points to what is happening or what happened after the bell on Friday, that 10-for-1 stock split. And that actually follows this dramatic rise that we've seen in the stock really since the start of the year and what we've seen over the last year and a half. Now, this move here adding to investor excitement surrounding AI, a trade that really has not shown any signs of slowing down. So what's ahead? We want to bring in Bob O'Donnell here. He's the president of Technalysis Research. Bob, a lot to talk to you about with Nvidia, and we'll get to Apple here in just a second. But first, talk to me about the significance of this and what you think the reaction is going to look like in the markets over the coming days.
Sure, Shauna. Look, the beauty of a 10-for-1 split like this is that the average person who couldn't afford that Nvidia stock can obviously jump in. And there's a lot of people who've been hearing about it. As Brian said, 5 years ago, nobody heard of Nvidia. I did, but not a lot of people.
Hey, I never questioned you, Bob. Never questioned you. I knew you were all Nvidia. I knew. I get it.
All good, Brian.
Okay.
All good.
Okay.
Anyway. No, but look, obviously that opens up a lot of opportunities for other people to jump into this AI play. And the reality is, look, they have positioned themselves incredibly well, Nvidia. Not only do they have the chips, they have that software, and that CUDA software has become the magic glue that people are attaching themselves to allow companies, organizations, big, all the big foundation model guys to use Nvidia stuff to drive these new services. Interestingly, we'll see if Apple actually does that. That'll be an interesting side discussion. But the bottom line is everybody else, OpenAI and IBM and all these other companies that are doing large foundation models and everything else, it's all being run on Nvidia. And as individual companies start to do some of this work themselves, of course, some of them are starting to buy these devices. So, the competition is heating up. AMD has never had stronger offerings. Intel is finally getting its Gaudi 3 act together to accelerate. We've got a bunch of smaller companies, but it's going to take a while for these guys to catch up. AMD, of course, is the one that's got the most opportunity in the near term. But it's a tough road for these competitors against Nvidia because they've cemented themselves in such a strong position.
Bob, over the weekend, I was reading a really cool Evercore note, and they are predicting more than $60 a share in earnings by 2030. Now, if you go to Yahoo Finance, click on Nvidia, go to the stats page, analyst consensus shows about $27 a share this year. I mean, almost a tripling in earnings through 2030. Is it crazy to think by 2030, Nvidia is by far the most valuable company in the world, and it's about a $5 to $6 trillion market cap company?
Well, certainly if things keep going in the way they are, that's absolutely within the realm of possibility. But let's think about a couple things. Number one, as I started to mention, competition is getting much tougher. And the truth is, nobody likes, especially in tech, to have one company completely dominate the way that Nvidia is right now. So you're going to see a lot of companies being more willing to try alternatives just to give them some leverage when it comes to working with Nvidia, which of course they will continue to do. Number two, anybody that's that big, you start to worry about regulatory concerns. What are the issues around that could pop up? And then finally, and the biggest question is, what if the way we start to do Gen AI changes? We've started to hear discussions. Apple's going to talk about this later today, doing some of that stuff on the device. That doesn't require the Nvidia chips. These big foundation models driving this, starting to shrink in size, so therefore perhaps I need a little bit less compute. These are the bigger tech questions, implementation questions that we have to watch long term. They're not going to change overnight, to be clear, but those are the big picture questions that, by 2030, certainly I think are going to be a factor.
All right, Bob, you mentioned Apple there, so let's talk about that big announcement that could be coming here today, gearing up for its Worldwide Developers Conference. It's 1 p.m. Eastern time. Lots of hype, lots of expectations surrounding that AI announcement that we are going to be expecting to hear. My question to you, though, is how big of a catalyst do you see this being for Apple stock?
Well, first of all, of course, Dave explaining to the world what AI actually means. It's not artificial intelligence. Apparently, it's going to be Apple intelligence. But anyway, look, here's the thing. Brian was raising this question earlier. What is it that's going to take people to machines? And, at the end of the day, a lot of this stuff apparently Apple, modest types of things, text summarization. Tell me what this website says. Tell me what this document says. generate an email for me automatically, remove all those people in front of my family on my vacation photos so I can clean it up. You know, nice practical things. The thing about it is when Apple does, and by the way, all that stuff's been available on Android phones and other places for a long time. The difference is it's Apple, right? And when Apple does it, a much larger audience sees what this is, starts to understand and comprehend what it is, and therefore it becomes a big thing, even though they are later to the game. And then the question, and again, Brian hinted at it, services. How do they start to monetize some of these features and add to that huge services pie that's been the biggest and most profitable part of the business for a long time?
Bob, I hear you. Siri digital assistant might be cool. The ability for me to erase a bunch of my friends out of photos from 5 years ago, I'm all for. Maybe I want to share those on social media. That's great. But are we still looking at Apple being a laggard in the AI arms race? This is a company arguably, 2 years behind some of the news flow from an OpenAI, a Microsoft, and other companies the like. Or should investors be concerned?
I mean, look, they are clearly behind, Brian, but they've been behind on plenty of other things, and that hasn't slowed them down. The bigger question for me is things like, rumored partnerships with OpenAI to integrate ChatGPT type technology into the Apple experience. That's not Apple's usual way of doing things. They like to invent it themselves, thank you very much, but they may have been forced in this particular situation because they've been so far behind to do that. And, we've seen some strange things happen with OpenAI. And of course, Microsoft is using OpenAI. And how does all of this intermingle and what are the implications of that? That's kind of the stuff I'm curious about. And, the other thing is timing wise, sometimes being a little bit late to the game on a brand new technology is just the right time. And it is timing this actually as, again, the mainstream of folks start to go, wow, actually, this really is cool. And this is the kind of stuff I want.
Time will tell. Bob O'Donnell, longtime Nvidia watcher and Technologist Research President and Chief Analyst. Always good to see you. Talk to you soon.
Thanks, guys.
All right, political uncertainty is rippling across Europe after a strong showing from far-right parties in Sunday's European elections prompted French President Emmanuel Macron to call a snap vote. The euro and French markets selling off on the news. Here to explain is Yahoo Finance's Madison Mills. Madison.
Thanks, Brian. So just to explain that snap election piece that you just mentioned there, that is a tool at Macron's disposal here. He is able to call for a complete dissolution of parliament and a revote, essentially. This means that all of those seats are up for grabs, including his own, the final tool at his disposal here, given that he lost this election. But the reason that we're seeing such a sell-off in the European markets, particularly in France today, is because that piece, the snap vote, was not priced in. If you take a look across all European markets, we're seeing moves to the downside. The CAC 40 here was down. This is the index in France. This was down over 2%. Earlier this morning off of this news, now paring those losses back just a little bit here as we move into the day. The euro dollar at the lowest level in a month off of this news. And again, the reason we're seeing this bigger sell-off is because, yes, these election results were anticipated, right? We're seeing the whole of Europe moving further into the far right when it comes to the candidates that we are seeing win these elections. But the snap vote was not priced in. And the reason I wanted to talk about this today is because this is a point that we can utilize when sussing out investor opportunities for the U.S. elections as well. It's not enough to have a take on whether or not Trump or Biden is going to win this election. You don't know what's going to happen after that. You don't know what the policy positioning is going to be. You don't know what those first 10 days in office are going to look like for either candidate once they're in the White House. This exact move that we saw from Macron today is the thing that investors here in the States should be watching and should be concerned about, because that is what's very difficult to price in. Now, we know that the upcoming elections in France are going to be on the 30th of June and July 7th. So the party that won over the past 24 hours is going to have a little bit of time in office to see how they're doing. The population is going to be able to see how they're doing before that vote. That is what Macron is hoping will allow him to stay in power. He says that he has faith in the French people with regards to that. But as the entire continent is moving further right, it does put a lot of risk on the table for the parliament as a whole, which investors and, of course, politicians like him had not anticipated.
All right, Maddie, great stuff. Thanks so much for breaking that down and exactly why something like this really matters here to our audience. Well, speaking of two critical tests here for the markets coming up, it's actually happening this week on Wednesday. The latest reading on inflation. We've also got the Fed decision. Now, May's Consumer Price Index report, that is going to be released ahead of the bell, and that's going to be followed by the Fed's interest rate decision at 2 p.m. Eastern time, followed by Chair Powell's press conference. Now, investors will be keeping a close eye on those projections for the remainder of the year. Yahoo Finance's Josh Schaefer joining us here at the desk. And Josh, I think the question that so many investors, money managers are asking themselves at this point is, yes, we do expect some sort of revision here from the Fed, some sort of scaling back in those expectations. But I think the question, though, is to the degree of that, how much of a scaling back are we going to see?
Yeah, it seems like right now the consensus among economists is that we're going to see one cut taken off the table as far as the projections that we're going to see in that summary of economic projections in the dot plots. We'll go from a consensus of 3 cuts to 2 cuts, which we should note is essentially what the market's pricing in right now, right? We're pricing in somewhere between 1.5 to 2 cuts, and then you get into talking about basis points, but we're close enough to 2 cuts where I feel like that would sort of be where the market is at. I think the key question will probably just be if we get any sort of hint about when the Fed might start cutting and sort of how that's going to work. I think that's becoming the larger question here is as we get further down the line and we need more inflation prints and more inflation prints, because let's be honest, the prints we're getting aren't giving anyone a lot of confidence, then you just run out of meetings, I think, at some point to make 2 cuts, right? How are you going to make 2 cuts if you don't start in September? Are you going to go in November and December? And that, I think, is probably the largest question heading into this week, because it feels like everyone is pretty settled right now on a cut is coming out of that dot plot, and that is okay.
I loved RBC's Lori Calvasino's notes this morning. I mean, she's saying maybe we don't, she stress tested her models and say if we don't get any rate cuts, the S&P 500 might fall 8%. To me, that sounds conservative, but you follow the markets, Josh.
Yeah, I mean, she's looking at a 10-year yield of 4.75% too. I think that's a key part of that, right, is the 10-year would actually rise a little bit from where it is now, and it stays there. But I think what Lori was sort of getting at, which made a lot of sense to me, Saz, was essentially the markets have priced in the soft landing right now, and any risk that inflation comes down a little bit slower than we expect, if you don't get very strong economic growth with that, a la the no landing scenario, right, where we really grow more than we expect, that's not good. And we're already at record highs, and I think that's something that investors do need to remember right now. We have had a good rally to start the year.
Because of Nvidia.
Yeah. Well, saying the S&P 500 might fall 8% from where we are, it would still close higher on the year, right? And I think that perspective is relevant here, that we have already priced in a lot of good news, so any bad news, you're probably going to get a little bit of a pullback.
That's true.
All right, Josh, thanks so much for breaking that down. Certainly a lot for investors to keep in mind here on what is going to be a very busy week. So let's talk about it, because we are just getting started here on Morning Brief. Coming up, the S&P 500, it's getting some new additions. CrowdStrike, GoDaddy, and KKR all moving higher on the news. We'll take a look at some of those top trending tickers next. Plus, gold rallying this year to new record highs. We will speak with the CEO of Barrick Gold later this hour. Plus, we're heading out to San Francisco for Apple's Worldwide Developers Conference, where our very own Dan Howley is live on the ground. Investors awaiting any announcements from the tech giant on their AI development. You won't want to miss that. We've got all this and more coming up on Yahoo Finance.
Hey, let's go around the horn. On a few Yahoo Finance trending tickers, Elliott has built up a nearly $2 billion stake in struggling Southwest, making it one of the airline's largest investors. We should note Elliott and Southwest did not return my request for comment here. Nonetheless, Elliott with a press release, Sean, and imagine being the CEO of Southwest. You awake today and you get a note from Elliott saying it wants to do three things. You want to enhance the board. And I should remind folks out there, on that board is longtime CEO Gary Kelly. He's the executive chairman. Elliott wants to upgrade leadership and undertake a comprehensive business review. And if they are allowed to do all of these things, they see Southwest potentially returning 77% over the next 12 months to $49 a share. Tough day for Bob Jordan, CEO of Southwest.
Tough day for Bob Jordan. Tough Monday morning here, waking up to this letter. And also what I thought was very significant within this letter, they're talking about the underperformance here of Southwest and really what we have seen the performance of Southwest compared to some of its rivals over the last several months, or really over the last year and a half. And Elliott making the case that because of that poor performance, they actually see Southwest as the most compelling airline turnaround opportunity within the last 2 decades. So that really puts this opportunity, this investment opportunity, at least in the eyes of Elliott, into perspective here. And I want to bring up a conversation that I had several months ago, and it was towards the end of last year. I had the opportunity to speak with Southwest CEO Bob Jordan. That was back in November, about the airline's position given some of those macroeconomic environment concerns right now. And here's what he had to tell me about some of the trends.
I've been in commercial for a long time before this job, and so trends can change on you. What's good for Southwest Airlines is we are well positioned. So if that occurs, what do you want? You want to be the low-cost provider, you want to have low fares, and that's the center of the Southwest business model combined with great people. So I think we're well positioned if that does happen.
So despite those optimistic comments that we heard there from Bob Jordan, now not necessarily a surprise, clearly he's going to remain upbeat in conversations like that. But even since the start of the year, we have seen a real underperformance in Southwest stock, and really just getting back to the crux of this argument here from Elliott. Since the start of the year, Southwest shares are actually in negative territory. That's compared to a nearly 30% gain in United and nearly 26% gain in Delta. So you see that discrepancy there, the massive gap in performance, and that's a huge reason why many of these investors are a little bit fed up with some of that performance that we've seen from Southwest.
You always get the big interviews, Shauna Smith. That's why I follow you every single morning. Bob Jordan there with Shauna Smith. But no, for this stock to be working again, let's pull Elliott out of the equation. Again, one of the most feared activist investors in all of Wall Street. This company comes knocking. You're going to have a rough few months as a leader. Nonetheless, they had the March 2022, and that's Southwest debacle during the holiday season. They're unable to get their Boeing planes that they need because of the many troubles over at Boeing. They don't have premium seating. I need premium seating. Delta's giving me premium seating. And that is starting to impact the company's results. Also, they need to improve how people actually onboard their planes. You put all these things together, you have a note out from Jefferies recently suggesting that Southwest may post, and this is really stunning, Shauna, an adjusted operating loss of about $108 million this year. The street consensus is for $600 million plus in profits. So the street has lost complete trust, and I think in the Southwest management team. And you could be looking at another material earnings warning. Keep in mind, the company warned a couple months ago, really hammered the stock, but the market is, I think, getting very concerned that there might be one more reset here, hence Elliott to the scene. Yeah, and I think that's why, by and large, the general, or at least the first take analyst reaction here this morning, not exactly a huge surprise that we're seeing some activist interest here from Elliott into Southwest. All right, let's take a look at a couple of other trending tickers. S&P 500 is getting some new additions. You've got CrowdStrike, GoDaddy, and KKR are going to be added to the index on June 24th. Now, the announcement sending all three shares moving higher here this morning. We started to see that reaction following the closing bell on Friday. So when you talk about some of the outperformance here, specifically CrowdStrike, and Saz, I know you've spoken to the CEO there in the past, they have seen some outperformance here within CrowdStrike, given the fact that they are a leader within the cybersecurity space. Lots of optimism on the street. I was going through some of the key goals that they have laid out over the last several quarters. $10 billion long-term revenue goal here. Analysts saying that is going to be the key here, obviously, to some of those future stock returns. So we're seeing that momentum here carry through, at least ahead of today's opening bell on the heels of that announcement of the S&P. No, right on, Shauna. And really a good note from the Morgan Stanley team. Hat tip Keith Weiss getting this one over to us. Headline on his report before this S&P 500 edition, the next $100 billion cybersecurity company. Now, Keith starts his report saying with an expanding TAM, that is total addressable market, improving upsells and free cash flow, we see CrowdStrike surpassing $100 billion market cap and potentially doubling in 4 to 5 years. I mean, the world of technology, Shawna, is only getting faster. You need to protect your systems, and this company's giving you what you need.
Yeah, that's why companies that are still spending, they're spending their money on exactly that. All right, let's take a look at Walmart. It's getting a bullish call here from JP Morgan, the firm upgrading the stock from neutral to overweight, raising its price target from $66 to $81 a share, saying that the retailer has a, quote, strong balance of defense and offense in a soft consumer backdrop. And I actually think that line there pretty much sums up this call. And it's very replicable. It was very similar to what we've heard from Walmart CFO over the last several quarters there within our discussion, saying that, yes, it is a very, very challenging time for the consumer. We are seeing consumers being a bit more cautious, pulling back in areas here of spending. They're spending on staples, but Walmart here seeing many of those higher end consumers downgrading here, or I guess shifting more of their spending spending dollars to a name like Walmart. So they're still benefiting despite all those macro challenges.
This is your presidential election consumer pick. If the consumer gets more cautious, they go to Walmart. And when they go into Walmart, they're seeing better selection and prices that Target can't beat. If the consumer does well into the presidential election season, surprise a few folks, where are they going? They're still going to Walmart. As we learned from CFO John David Rainey a couple weeks ago, he came on our air after another big quarterly beat, saying higher income households are coming to Walmart. Why? Because it's just a better place to shop. It's clean, it's better lit. It's not the funky Walmart from 10, 15 years ago. It's just a better shopping experience. And I should add too, this is a company that has expanded the number of items significantly online, and then you can, in many cases, order those products online and pick them up in the store and do the rest of your shopping. This company is a winner, potentially in either climate, into the back half of the year.
You're seeing gains here of nearly 2% ahead of the open. All right, well, we are just minutes away from the opening bell on Wall Street, taking a look at how the trading day is shaping up. You're looking at all three of the major averages on track to open the trading day in negative territory. We've got that for you when we come back. The opening bell on Wall Street marking a new start to the trading week. Let's do a quick check here of the markets. When you take a look at the major averages, we're actually seeing some movement here to the downside at the open, although not too significant, so plenty of time for things to turn around here. If you got the S&P off just about 0.2%, you got the Dow just below the flat line. When you take a look at that sector action that we're seeing here, early action. You've got energy, consumer staples, interesting moves there, just trading above to the flat line here. Financials, the worst performer as those opening trades shake out. But again, the big focus here, one of the big focuses here for investors at the open is going to be Nvidia.
10-for-1 stock play. Can I promote your article real quick? Shauna Smith, great article yesterday morning on Yahoo Finance looking at the 10-for-1 stock split. Shauna, I mean, you're just killing it.
Well, thank you. But although, that's interesting when you're taking a look at that move, because that's exactly what many of the strategists and analysts told me. We could see a bit of selling after this happens, but they're actually, most of them, viewing this as a buying opportunity, given some of that momentum that we certainly have seen in Nvidia.
I mean, that's the insight you pay big money for. Jared Blickery is standing by with a look at the key market moves this Monday morning.
Well, thank you. Since you got the screen right there, I'm just going to pull up Nvidia and look at that price. That is 1/10 of the price that we saw on Friday or thereabouts, minus about 92 basis points right here. But I want to focus on the overall market. So I'm going to go back to the S&P 500. All the majors are set to be down about 3 days in a row right now. Not a terrible thing, but you can see the S&P 500 is right around its record highs, looking for some momentum in one direction or the other. You can also see the Nasdaq is in a very similar position. But my focus is on the 10-year T-note yield and also bonds. And so Friday was a huge move up on the employment situation report from a level of support. So it looks like 10-year T-note yield, that has some room to run here, maybe all the way up to 4.5%, at least there, maybe 4.75%. And also taking a look at the US dollar index, that bounced off support. So my point is that both of these markets have room to run, and that could be a headwind for equities in the very short term. Longer term, the bullish picture not changed at all. We took a look at the sectors here. I do want to look at the futures action. Silver and gold bouncing back after a terrible day on Friday. That's live cattle. We don't want that. But here's silver. And let me just show you that year-to-date chart. Just looking for fresh records, but stalling out near record highs. Guys.
All right, Jared, thanks so much for breaking down some of that movement that we're seeing there. All right, let's get back to that big story of the day. And here we are, just about 3 minutes into the open of the trading day. You do have stocks slipping just a bit, but really the story of the last several months in the market has been this massive outperformance that we've seen in just a small handful of tech stocks here, really largely driving the direction of the markets here since the start of the year. Nvidia, of course, leading the way, a lot riding on the sector's rally. Here to break it all down, we want to bring in Matt Miskin. He is John Hancock Investment Management's co-chief investment strategist. Great to see you here. So when we talk about the massive outperformance in tech, we've got the 10-for-1 stock split from Nvidia here today, and I think there really has been this refocus on the AI trade. Matt, are you at all concerned just about the concentration that we're seeing in the market and what risk that might pose here over the coming weeks and coming months?
Well, it is certainly historic in nature. The market has never been this concentrated ever before. So the 33% or so of the S&P 500 is just in the top 10 stocks. Things could be worse, though, right? Because these companies are printing money in terms of profits. They've got great profit margins. They've got great balance sheets. They're the highest quality stocks. Right now, the market is being driven from the quality factor and the momentum factor being married together. That isn't the worst thing. In the tech bubble, these companies weren't making money. They did not have solid profit margins. But for us, they are getting rich. They are getting expensive. We are moving down in cap. You don't have to go far. Mid cap or even $100 billion market cap nowadays feels more like mid cap because of these $1 trillion companies. But we're looking for cheaper options, a little bit down in cap. We're still avoiding small, but there's valuation opportunities. You just don't have to go far to find them.
Matt, even when you look at the valuations on some of these trillion-dollar tech giants, I mean, Apple over $3 trillion, Nvidia close to $3 trillion, can the argument be made, given how much potential they have in free cash flow and earnings over the next decade, these stocks still might be very cheap?
Yeah, they're going to grow into it, over time. And the AI, narrative, we think actually is one that is going to be a powerful force for the economy. The U.S. economy just can't grow through government fiscal stimulus forever. We can't just, provide more and more stimulus. And the Fed also is relatively restrictive, but it's going to be hard for the economy to grow without such great support. And we think productivity is going to be the key engine of growth. So what is productivity? It's basically GDP divided by number of hours worked of employees. Well, AI helps people work less. It's all about getting more done with less work. and we think AI is going to be a huge part of that as a secular theme. We believe the best earnings engine in the world is technology. We've been overweight that for the last 5 years. We are still overweight it as we go throughout the course of 2024.
All right, Matt, let's move from AI to another piece of news that's certainly top of mind here for investors, and that's going to be the CPI print that's out on Wednesday. We've also got the Fed decision following just a few short hours later. I'm curious just to get your perspective on the significance of both of those things happening within the same day, maybe what that's going to tell us about should we be expecting some increased volatility as a result?
Absolutely. I mean, you couldn't script this any better in terms of two major market moving events on the same day. CPI days are always ones where volatility presents itself. And then that Fed meeting right after that is pretty wild. So, I mean, for us, inflation data continues to show relatively strength in the housing market. Shelter or housing puts up about 2/3 of the CPI numbers, and it's not slowing. We're not seeing it slow that much in terms of housing data. So that's going to stay relatively firm in our view. And then the Fed might, Powell has been dovish in nearly every opportunity he's had. He's kept, in essence, this inflation impulse alive in our view. But in terms of the summary of economic projections, where they write down how many Fed rate cuts they think in 2024, that might not be 3. It might be 1 this time or none. And the market might not like that. The cuts or forecasting of cuts as forward guidance has been great news for the market. Markets loved it. But if the Fed isn't going to be as supportive, we think that could create volatility over the week. We're looking for a stronger dollar, a flattening of the yield curve, and maybe actually a risk-off bid in markets over the course of the week.
So, Matt, what's the average investor to do here? Should they assume no rate cuts, 10% market correction, sell Nvidia?
Yeah, I mean, there's three suggestions right there. Right now we're just looking at high quality income about 5 to 6% as a really good opportunity in portfolios. Our view is income is going to be a bigger driver of returns. We're locking in 5 to 6% in high quality income for the next 5 to 7 years, and we think if you get that done and then think about other things after that, that'll situate you well. Equity wise, we are in the quality part of the market, and that AI name is a part of it. So the quality factor across global equities is what we're looking for. High ROE stocks, holding stocks. We're not overweight and we're underweight smaller cap, less risky. We're underweight international. We're overweight US large cap, mid cap, and quality. Be patient, get income, be paid to wait, and then wait for better opportunities. As we think at the end of the year into next year, we're going to be presenting a better valuation entry point for markets.
Matt Miskin, John Hancock, Investment Management, Co-Chief Investment Strategist. Always good to see you. Talk to you soon. Costco can't keep its gold bars in stock ahead of the presidential election as fears mount. So how much higher can gold prices go this year? Barrick Gold CEO Mark Bristow joins us on the other side of the break.
Gold's run is taking prices to record highs this year. Right now, it's up just about 12% the year to date, just outpacing the S&P 500's climb. Now, the surge that we have seen is in part thanks to emerging market central banks scooping up gold at record rates. So where do we go from here? We want to bring in our next guest for more on that. We have Mark Bristow. He is Barrick Gold's CEO. Mark, it's great to see you here. So Barrick Gold, if our viewers are not familiar, gold and copper producer. So I'm curious just your reaction to this run-up that we've seen in gold prices and in copper prices as well, and where you think that trade is headed from here.
Very interesting run-up, Sienna, because it's been the gold price that's moved. The equities have lagged. And also we've seen sell down on the ETF. So interesting, and I think it's to your point, people searching for some protection in this very mixed up world, and your point about the central banks buying is important. And of course we know that China has been buying, although China did share with us that they hadn't bought the last month, so that's good for gold.
Mark, Brian here, good to see you again. It's been a while. Look, I was just trying to go to Costco to pick up a steak. I got trampled. Somebody looking for a Costco gold bar. I mean, these are just amazing times. But given demand as something as simple as a gold bar from Costco, what are you doing in terms of production? How has this run up in gold prices to beyond $2,300 an ounce? How has this changed your operations this year? And how does it change your outlook for the back half of this year?
So Ryan, mining is a long-term game. It's capital intensive. You've got to allocate capital over the long term. We did this big deal with Randgold back in 2019. We've been consolidating. It's all about delivery. And we've expanding our copper production and overall looking to grow our production by 30% by the end of the decade. And bring our costs down. And that's the game in mining. And so higher gold prices are always helpful. They don't always stay up there. They go down and they go up. But I think what we're seeing is people worried about the global economy. And to some of your previous speakers, we've seen the economies driven by a select few companies, and people are worried about that. And as you know, Ryan, the world is not as stable as it was just a decade ago.
You mentioned, Mark, it is a mixed up world, and you also mentioned copper. Now, copper is often seen as a leading indicator for the global economy. What are you seeing in terms of copper demand in the U.S., and can you contrast that with what you're seeing in China?
I think people are realizing that the copper market is going to be squeezed, the supply side. And so there's a response to that, and we've seen a couple of big producers close down in the last year, and that's also worried people. And I think more so now, copper is all about industrialization in a cleaner fashion, and that's what's driving copper. I think it's going to have a bumpy ride for the next 18 months to 2.5 years, but definitely there's a big squeeze on the supply side of copper. And on the demand side, we have to keep developing, and the commitment to transition to a cleaner global energy industry is very real, and that drives copper.
Mark, so then as a result, do you think there will be even more consolidation within the sector as a result?
You know, it's a question everyone wants, because you people work in instant time. But consolidation doesn't improve the production profile. The industry needs many more copper mines, and that requires the miners to get out there and find new operations, and that's what's driving Barrick's growth today, is the fact that we're bringing in new production by 2028.
Mark, we're asking all CEOs this, and I'll put this one to you. Has the Biden administration been friendly to your operations, or have they added more, I guess, regulatory constraint to your business and your industry?
No, I think they've made it a lot more challenging. And, the United States is a big supplier, a big consumer of all metals. And in fact, Barrick is one of the largest miners in the United States, and it's difficult. Today, we have to work with more than 20 different departments within the federal government just to get our job done every day.
Mark, when it comes to what exactly this means for your business, you talked about how big of a catalyst this is going to be for your industry, just in terms of the timeline of being able to scale your business, how long that takes, and what exactly that ultimately looks like when we talk about the supply versus demand picture. What do you see as some of those longer term implications? And then you have the politics side of it that sounds like it's complicating that, at least to some extent.
Yes, I think that's true, and that's the challenge for miners. We've got to embrace our real stakeholders, and they are our host countries and the communities around our mines, and of course the shareholders as well. And so, and it takes somewhere between 10 and 20 years to discover and develop a large copper mine, and not much less time for a gold mine, and that goes for all mines around the world. And so miners, for them to really benefit from this increasing demand, we are all going to have to learn to work in more complicated jurisdictions. And I think that's important overall, because sometimes within the United States, we sort of really inward looking, and for this planet to be a better planet for all, for future generations, we need to uplift everyone across the globe and not just focus on our sort of provincial environment.
Mark Bristow, Barrick Gold CEO, always good to see you. We'll talk to you soon.
Thank you, Ryan.
It's either two outcomes for Tesla CEO Elon Musk this week. He either gets even richer or he considers life after or outside of Tesla. We have more on Musk's closely watched pay package coming up. Investors are eagerly awaiting the vote on Elon Musk's CEO pay package set for June 13th. Shareholders will decide if the Tesla chief can keep his record $56 billion compensation package that was awarded to him back in 2018. Yahoo Finance's Alexis Keene has been looking into the recent trends in so-called say-on-pay votes. Alexis.
Yeah, so there's some mixed support coming out from major shareholders in Tesla. You had last week Barron Capital's Ron Barron saying, vote yes, let him have this money. They have about a 0.5% stake in the company. Then on the other hand, you had over this weekend Norway's Sovereign Wealth Fund coming out, a 1% stakeholder approximately, saying, no, we don't support this. But look, at the bottom line is this will come down to asset managers like BlackRock and Vanguard that tend to support management in these initiatives and have a significant stake in the company when you start adding those together. Now, the trend, though, is what I've been looking at in these say-on-pay packages. And increasingly, shareholders are in favor of paying the CEOs what their management is saying they should get. So if you take a look at companies in the S&P over the past 5 years, we're going to show you 3 years here, the percentage of no votes has been falling. Take a look at 2022 to 2024. Note that 2024, of course, isn't fully cooked yet. We don't have all the numbers, all the votes on 2024. But you have in 2022, 4.6% of these votes failing, or 22 is the hard number there. Then you go to 2023, 2.4% failing, 12 there. And then this year, less than 1%. And so 2 companies so far have had their shareholders say no. So a really big change here, and shareholders saying okay to these plans, all while, of course, CEO pay is on the rise. So you have some incongruent kind of initiatives there. But for Tesla shareholders, they have approximately, for their non-insiders, so the shareholders that will be voting on this pay package for Musk, you have roughly 50% retail, roughly 50% institutional, not quite exactly. And on top of it, when you look at studies of how many retail shareholders, with Tesla having a significant number of retail shareholders here, how many actually come to the table and cast a vote? Well, it's been changing over the years. There's not a ton of data on it, but the thinking is, over the past 5 years, from those who research this area, is that, look, they can be influential and they will show up when they really, really care. And look, this has gotten so much media attention, this pay package. So I wouldn't be surprised if we see those numbers pretty sky high on this round. But that's just a prediction.
It certainly has. We've been talking about it, what feels like for well over months at this point. But Alexis, I think investors out there, our viewers, are trying to figure out what exactly this means for the stock, what this means for the share price here. What did you find out?
So analysts are saying that if it's a yes, they would think that that would be supportive of the stock and the number would go up. On the other hand, a no, that it would go down. Now, that is perhaps putting into question, if it's a no, how long does Elon Musk stick around, or how much of his time does he allocate to this company given his other interests? So I'm not exactly sure what the thinking is and all of the permutations of why that is, but that's kind of the consensus out there right now.
Musk believers.
Tough life.
Always standing by them. All right, Alexis, great stuff. Thanks so much. Well, coming up next, we've got market facing 2 big tests this week, the Fed decision and a key print on inflation. We are going to dive into what this could ultimately mean for the market, plus focusing on Apple ahead of its Worldwide Developers Conference later on this afternoon. We'll discuss what the tech giant needs to reveal about its use of AI. Saz, it's been fun.
I want to buy, it's an honor to be here. I love what you and Brad Smith do every single day. I'm just filling in the seat, guys.
There we go. Keep right here on Yahoo Finance, because we've got much more ahead. Madison Mills is joining me at the desk in just about 4 minutes. We'll be right back. It's 10 a.m. here in New York City. I'm Sean Smith alongside Madison Mills. Let's dive into the catalyst moving the markets today.
Stocks facing several big tests this week with a double whammy of the Fed decision and CPI coming out on Wednesday here. If the macro wasn't enough for you, you've also got a slew of company news coming from the biggest tech names this week. We're going to tell you which event is likely to define the trade coming up here.
All right, and Apple's annual developers conference kicking off this afternoon. The iPhone maker under some pressure to prove itself as a leading player in the AI race. We'll discuss how high the bar is for the tech giant.
And Nvidia's first trading day following that stock split from Friday. We will dive into how much more room the company shares have to run and what the outlook is for other AI names in the space.
But first, we have to talk about the two big stories expected to drive the markets here this week. We've got the CPI print and the Fed's decision. Both are out on Wednesday. Year over year, core consumer price inflation is expected to come in a bit cooler than the month prior. Now, this will come ahead of the Fed decision and the subsequent presser from Fed Chair Jay Powell. So how will the totality of the data impact Powell's commentary and the Fed's path forward? We want to bring in Jason Furman. He is Harvard's Kennedy School of Government professor and former Council of Economic Advisors, a chairman under President Obama. It's great to see you again. So let's start with the significance of these two events happening on the same day. There has been some hiccups in the Fed's fight here to tame inflation. What are you expecting to see, and ultimately how that's going to shape the Fed's next move?
Yeah, I mean, obviously they won't be able to respond to the data, and they're locked for no move this month. I don't think they're going to consider a move till September. I doubt they're going to cut rates until December. Even if it's a decent CPI print, the problem is, the good months it's at 2%, the bad months it's way above 2%. That means it's averaging out to a decent amount above 2%.
Jason, you mentioned your call of December. To what extent is the November election part of that decision for you?
I think it raises the bar just a little bit. It shouldn't, but they don't want to appear political, and paradoxically not appearing political means they'll need a little bit of a higher bar. But I think the bigger issue is back in December, we were looking at 6-month annualized core PCE inflation of 1.9. 2 months later, it turned to 3. They're going to need a lot of data to reassure themselves that it's real. So even if we're looking at 6 months in a row of 2% inflation, that may not even be enough for them when they've just seen this worm turn so many times before.
Jason, talk to us and explain to the viewers just why it has been so difficult for the Fed to tame inflation and why this last mile continues to be a bumpy one at best.
Yeah, look, we've gotten further than I would have thought without anything like a recession. But some of this inflation probably is embedded in expectations. You see high wage growth leads to high price growth. High price growth leads to high wage growth. And that's a staggered process. So in the best case, it's going to take a while for it to asymptote itself back down towards 2. And in the worst case, it would require some, elevated unemployment if that's what the Fed decides it needs to do to get there.
You know that the rapidly growing population is playing into some of the headlines that we are looking at when it comes to the labor market. Can you explain the degree to which that is playing into this picture that we continue to have this robust growth in our economy and how much that's true given that population growth contribution?
Yeah, I mean, over the last year, we've seen 250,000 jobs a month, and yet the unemployment rate has drifted up. That's extraordinary. A bit of that is some increased labor force participation, but a lot of it is that the immigration inflows are just much larger than we thought. Now, it looks like those immigration inflows are starting to slow. So where it looks like we're going to go back to a world where break-even job growth is, more like 100 to 150,000 than possibly the 300,000 break-even we've had over the last year. So big question about how much immigration supports things going forward, but in the rearview mirror, it's been a big part of the growth story, a big part of the job story.
Well, talk about the impact of President Biden's executive order on immigration recently, which would limit asylum at the border, to put it very simply. What read-through could that have on the broader jobs data that we are seeing? And could that lead to a potential softness that folks would not be comfortable with?
Yeah. So his effort is part of the reason why I think immigration inflows are going to be slower going forward than they have been in the past. Now, this matters more for the number of jobs than it does for GDP, because a lot of the workers we're talking about here sort of produce less output per hour and add proportionately less to GDP. But in general, one of the big strengths of the US economy, one of the reasons we're doing so much better than so many other advanced economies is immigration. And at all levels, it's something we want to figure out how to encourage, but of course, encourage it in a lawful and legal way.
Jason, how big of a reason, just in terms of the influx that we have seen of immigration, the high numbers, is that a big reason as to why the US economy has been able to avoid a recession up until this point?
I think it's part of the reason, but we've been growing at about 2.75% over the last year, and immigration's a part of that. Demand is a big part of that too. We have a very large budget deficit. We have an unusually large budget deficit for an economy that's in as good shape as it is right now, and that's definitely playing a pretty big role in our economic strength as well. What that means for the medium and long term, though, is more dicey.
So, Jason, you note that we have the perils of recession on one side and the risk of prolonged high inflation on the other. Is it a zero-sum game here? Do we have to pick one or the other?
We don't get the choice. We get what we get, and we don't get upset. So yes, I'm rooting for a soft landing. I think there's a decent chance that we're going to be able to complete that soft landing. But there are these two perils on the two sides. I think at the current moment, the inflation peril is still the greater one, because we actually do have inflation right now, and the best forecast of the future is what we've gone through. But recession's an issue as well. So that's what the Fed's going to be navigating over the remainder of this year and forward.
All right, Jason, always great to speak with you. Thank you so much for joining us there. That was Jason Furman. He is Harvard's Kennedy School of Government professor and former CEA chairman under President Obama as well. Now, we are a little less than 3 hours out from the start of Apple's annual Worldwide Developers Conference here. Apple CEO Tim Cook posting on X this image this morning in anticipation of the event. Look at that beautiful skyline there. There's a lot riding on this conference, of course, for Apple. Wall Street has criticized the company for falling behind in terms of the AI boom. Apple looking to make a big splash at the event, and Yahoo Finance is on the ground there to get an inside look at it. Coming at us live from outside Apple's headquarters in Cupertino, we have Yahoo Finance's Dan Howley. Dan, great to speak with you. Thanks for joining us from the ground there. Talk to me about what you are anticipating heading into the day today, given just the high bar that Apple has to hit with regards to AI.
Yeah, Maddie, this is going to be a big deal, right? For Apple and for Wall Street. For the consumer, we'll see. But really what Apple is expected to do here is announce their new AI initiative. According to Bloomberg's Mark Gurman, it's going to be called Apple Intelligence AI. Pretty, spiffy planning there on their part, I guess. And what it's going to do is allow for smarter versions of Siri, smarter replies when it comes to text and email, photo editing tools, basically a more responsive and reactive operating system overall, right? So you would use the AI aspect to kind of ensure that, say you have notifications coming in, there'll be smarter notifications. They'll come in when you need them. When you don't need them, they'll kind of fall back into the background. And so that's kind of the way that Apple appears to be kind of trying to position this as a helper, not so much as a, gee, wow, look at this wild chatbot that I can speak to that can make funny poems, right? There have been talks that they're working on their own chatbot, but I don't necessarily think that that's going to be something that consumers overall will want to use and would start to drive sales. I think really, when I said that consumers will see how they feel about this, this I feel comes more down to what Wall Street wants Apple to do, not necessarily what consumers are looking for at the moment. Keep in mind that overall, yes, we've seen a lot of talk about AI since 2022 and ChatGPT kind of exploded. But for a consumer side of things, there hasn't really been all that much excitement. It's more of an enterprise endeavor. You have things like Microsoft, obviously Google, Amazon, Meta adding some of that, but it's still an enterprise initiative because it's powering its feeds. And so for something like Apple, it really comes down to whether or not it'll be helpful for consumers. I think what they're going to do will be helpful. We've seen similar options from Google and Samsung as well as far as their AI goes. But really, I think it's Wall Street saying, well, look, Microsoft has done this, Google's done this, OpenAI's done this. How come you guys aren't doing this? And then once they do announce it, we'll see what Wall Street has to say overall. But I think for the average consumer, when you're looking at what this truly means, I think that's something that's going to have to remain to be seen.
All right, Dan and Hallie, thanks so much for breaking it down. We hear the birds chirping in the background. Looks like a nice little day that you guys got there. Hope you're following along. Hallie, thanks so much. Well, again, let's stick with Apple because many investors are viewing Apple's Worldwide Developers Conference and that expected AI announcement as a catalyst for the stock. Now, increasing competition in China, waning demand, along with patent and regulatory battles, that has actually weighed on shares in recent months. The stock is now just above the flat line on the year, lagging far behind many of its big tech peers. So how should investors be considering their positioning in Apple with this upcoming announcement in focus? Here to answer that question and more, we want to bring Kim for us. She's Boca Capital Partners founder and chief investment officer. Kim, it's great to see you again. So given what Dan was just telling us, what we have in mind that we're going to be hearing from Apple, if they do announce some sort of initiative on the AI front, which seems like a sure thing almost at this point, how big of a catalyst is that going to be for shares?
Sure. Well, I mean, that's what investors really have to make their mind up about. I guess for the developed world and the wealthiest people in that developed world, Apple is the go-to appliance to keep you connected to, well, everything, right? And it has to be fresh and new and wonderful to get people to now spend over $1,000 for a new iPhone. And with each release, they keep getting more expensive and people keep holding on to them longer. And that's the problem. At the end of the day, even though Apple sells services, they sell hardware. So what I think Wall Street really wants to see are compelling reasons why somebody would trade in a perfectly good phone for this new AI-enabled Apple. I love Apple Intelligence or Apple, whatever the moniker is, but AI, at Apple. I think that is what the driver is. And if you think that's going to happen, maybe you should buy shares if you don't own them.
Well, Kim, as you just said, that is the big question, right? Are me and Shauna going to run to upgrade our phones early because of AI-powered emojis? I don't necessarily know that we are, right? So what are you looking at in your, Apple's one of those names that you put so much personal data into when you're talking about it, but what are you looking at in your formulations to suss out the likelihood of this really driving more demand for Apple?
Sure. Well, I think we all have an idea of what the perfect device is that we want to use. And in most times, we get to talk to it, and it talks back to us, and it gets us answers. And Siri really did kind of push that envelope a whole further than anybody else had, especially if you consider it was on a phone in your pocket. So imagine that. But I think this new version of Siri is going to have to work across apps on the not just Apple apps, but everybody's apps for it to be really meaningful. And that's why they're putting this out today at the Worldwide Developers Conference, is to get all the developers excited about using Siri to be able to allow the end customer to have that really great magical experience of saying, let's just pick something out of the air, hey Siri, where should I have lunch? And can you order that lunch for me?
When it comes to what Apple has done in the past and using just history as a guide, some of the concerns surrounding Apple stock and the fact that they have been late to the game when it comes to AI, are some of those concerns overblown at this point? And I guess to what extent do you really see where Apple is trading now a real buying opportunity?
Sure. Well, I think I wouldn't say fairly priced, but it certainly has recovered from earlier this year. And yes, there was a huge penalty that they didn't have those two letters being thrown around with respect to Apple, which is AI. Like anything earlier this year that had AI enabled, or maybe it's been over the past couple of years, the AI importance as a buzzword has been growing. So I think they have been penalized. I would say that they've had some real issues. You brought this up in the intro into this piece about China. China has been a tremendous hurt to this company. A little bit could be political because of the tariffs and all of that fallout, but some of it was honestly just better homegrown, probably cheaper options than Apple. Now, that being said, Apple really does excel at the consumer experience. So I think if you're going to be a long-time holder, which we tend to be, our typical hold times are 3 to 5 years. So looking out in the future, I think Apple has a nice runway ahead of it. And maybe on a sell-off, you should add some shares or initiate a position if you don't have any.
Well, Kim, this brings me to a point that our tech reporter who's on the ground in Cupertino brought up that I thought was so apt. He said that they might be giving Wall Street what they want today, but not necessarily consumers. Yes. So I'm curious from your perspective, how much of a risk is it if Apple is able to please Wall Street today, but they're not pleasing consumers?
I think that that's the whole point behind today, because consumers don't tune in to the Worldwide Developer Conference, right? It's Nerdapalooza for Apple developers, which is a good thing, okay? I mean, I'm making light of it, but this is a Wall Street focused, but really for the developers, getting them excited about putting their company's money, time, and effort into building out even more of their platform on Apple. And that is what this is the whole deal, the whole focus for Apple and the developers are, tell me more, why should I be in your ecosystem? So I think it will be a perfect thing, even if consumers yawn at this. What they really want to see is probably in 3 to 4 months' time, you know, a new product, a new iPhone that has some of this enabled and is exciting for customers.
All right, Kim, we want to switch gears here and talk about another tech giant that's really catching investors' attention here today. We're about 45 minutes into the trading day and taking a look at Nvidia. It's actually trading off just about 2%. Now, the move lower comes on the heels of the company's 10-for-1 stock split. This is the first trading day that this has taken place. And Kim, my question to you is, should investors be viewing this as a buying opportunity? Yes, we're expected to see some increased volatility surrounding this name because of that retail investor interest. But are you viewing this still that Nvidia is priced now and it makes sense to buy in at this point?
I don't know. I mean, I think that it has run far and fast. It has done an incredible job at creating a product that can be used effectively in this build out of generative AI especially, and it's being used in server farms. But I'm always cautious because, you know, we're assuming that by the current price and the current thought behind Nvidia, that this company is going to rule AI forever and ever. Amen. You know, everybody can close up and go home and do nothing. You know, that's it. This is the company. Mm-hmm. I don't believe that. I believe that the huge margins are going to be attractive. And here's a crazy idea. Maybe some chip designer will come up with an even better way to be useful in the AI ecosystem. They do have a really great jumpstart on everybody else in the chip making business for AI, but I wouldn't count all other players out.
Well, Kim, we're going to have you on again so that I can get into which player you think is most positioned for that. But really appreciate you joining us, and thanks for the insight. That was Kim Forrest. She's Boca Capital Partners founder and chief investment officer. We're going to stick with the Nvidia story here. As Shauna was mentioning, that stock trading to the downside, down just nearly 1.5%, a little over that. Now, typically stocks do tend to outperform the S&P 500 after a stock split, perhaps seeing a little selling off of the stock just for today here. But after those stock splits, we do see average returns 1 year later of 25% versus about 12% for the broader market. That is according to analysis here from Bank of America. But with Nvidia already surging over 200% in the last year, the big question is, can that climb higher be a little bit more difficult for the tech juggernaut? Yahoo Finance asked Bob O'Donnell, he is Technalysis Research President and Chief Analyst, about the challenges the company may face ahead. Here's what he had to say.
Competition is getting much tougher. And the truth is, nobody likes, especially in tech, to have one company completely dominate the way that Nvidia is right now. So you're going to see a lot of companies being more willing to try alternatives just to give them some leverage when it comes to working with Nvidia, which of course they will continue to do.
And Shauna, that really mirrors what Kim was saying, that there could be other players to come in and take market share from Nvidia, especially if they're able to take on a little bit more of an affordable approach. But the flip side of that is this call from Evercore this morning saying they observed that at each successive computing era, the ecosystem players represent a larger weighting of the S&P. They think that Nvidia is going to take up a 15% weight in the S&P 500 moving forward here.
Yeah, and that note actually caught my attention too, because they also put it in perspective of where we are in this story. And following that line, they then went on to say that we were only 5 to 8 years into a 15 to 20 year transition. So you talk about that opportunity that's ahead here for Nvidia, even if some of their rivals gain a little bit more market share, are able to better compete with with the name that has really been dominating the industry. They are right now, they do have a massive lead amongst their competitors. They have announced 2 chips here over the coming years, which has also reignited some of that excitement. We've seen that play out over the last several weeks. So I think when you take a look at the historical performance following companies, following that stock split, now the data is a bit split. You just referenced the data that we got out here from Bank of America. Goldman was actually out with a note over the weekend saying that, yes, we typically do see some excitement surrounding the name following the announcement, but after we do see that stock split, they don't really see real trend here in terms of outperformance versus underperformance in some of those names. So I think a lot of it is very story specific, but I do think companies tend to do this when management and executives are very confident within their own business story. And I think that is clearly the case here with Nvidia. So you take that and couple it with really just the sheer momentum that we have seen in the stock over the last several quarters. And it's hard to argue against a name which one has been so dominant within this industry. And then you take a look at many of these projections, more CapEx spend is expected to be allocated towards AI. So it's hard to argue that really this momentum rally could slow down anytime soon significantly.
It's a great point, Shauna, and I know you wrote about it as well, just the difference in terms of stock performance after split. Like you said, it can be a name-specific story. But one other data point for Nvidia, for the bulls out there, their valuation has actually decreased based on how much their profits have increased over time. So the valuation story continues to be a sticking point for a lot of investors. That valuation for Nvidia is starting to make a lot of sense when you think about their revenue and profits. You're going to have all of your markets action ahead. Stay tuned for more. We're going to be talking all the big tech names you need to be watching ahead, and this is Catalysts. Let's get to some trending tickers that we are watching on this Monday morning. We've got to start, of course, with GameStop. That stock moving down to the downside here, a little over 2%. Shares of GME following big losses on Friday after the trader known as Roaring Kitty hosted his first YouTube live stream in 3 years. Now, the company also released their earnings early and announced a share sale plan after that last week, that coming on Friday. And Shauna, just to point to the kind of context of these gains, they lost over $6 billion in market value on Friday. Now, they were moving to the upside this morning. Now they're moving to the downside, just like any other day for GME. But it does seem like this kind of release of their earnings early and just seeing those company fundamentals might have been, dare I say it, a touch of a wake-up call for investors that don't want to look at the fundamentals for a company like GameStop. But I could be believing too much here.
Yeah, and I also think you have Roaring Kitty's YouTube live stream, which also didn't really live up to some of the hype that had been expected here at noon yesterday, or failed, maybe I should say, to reignite some of that hype that maybe investors had expected to see here. But again, we're seeing this move to the downside, not necessarily a huge surprise given the rate of the selling that we did see on Friday. And Maddie, I think you're absolutely right? When you take a look at this story, materially nothing has really changed. When you take a look at the fundamentals, still a number of challenges laid out here in front of GameStop. You take a look at the slowing sales, they're wider than expected, the wider loss than analysts had expected here, most recent early announcements. So I think there's a lot of reason to be concerned, and maybe this is enough for some of those retail investors, for some of those investors in general, to think twice and maybe stop some of that momentum that we had seen. But clearly, volatility, nothing new when it comes to these meme names. And like when you see some of that movement that we've seen in GameStop, a handful of other names that have been caught up in the meme trade, like AMC, have also been along for what has been a pretty dramatic ride here over the last several weeks. All right, let's take a look at AMD, because shares are slipping today after getting a downgrade from Morgan Stanley. Now, they lowered their call on the stock to equal weight from overweight. They maintain, though, their price target of $176 a share, just above where it's trading today. Now, the firm saying that investor expectation for AMD's AI business seems too high. So really, essentially, what this call is calling into question is the current valuation of the stock. And they're saying, given those very lofty expectations that the street is anticipating up until this point, they don't really see much room here to the upside from the current value. And he also went on to say that he thinks AMD looks very expensive when you compare it to Nvidia and when you compare it to a name like Broadcom, two stocks that he sees more likely here to see upward revisions on their AI businesses. So again, they downgraded the name. They maintained that 176 price target, again, on those valuation concerns. He actually likes Broadcom at this point, and that's a name that he actually ended up upgrading here to overweight. So again, a bit of a contrast in terms of what he's seeing valuation rise within the AI plays.
Yeah, it's really interesting to note that, because there was a question about whether or not this stock looked expensive in comparison with an Nvidia, with a Broadcom, where, like we were saying earlier, the valuations just make a little bit more sense given the revenue picture that we're seeing coming out of those names there. Having said that, this is a name that has 50 buys, 12 holds, and 0 sells. If you look a lot across the analyst ratings that are tracked by Bloomberg here, the average PT, the price target, is still at 188. So seeing still some bullish sentiment surrounding this stock, but the question remains about the kind of growth and room to run moving forward. Are they going to be able to maintain some of the growth that we've seen in the space? Is it going to be able to stay in the AI winners bucket when you've got Nvidia kind of soaking up a lot of the energy in that room there? We're going to have to track that moving forward. And shares of Carvana also getting a boost this morning here after JP Morgan named the company a top pick, citing its strong execution in sourcing a broad array of vehicles at varied prices here. And I just want to take a look at this, because this does come after Carvana did reaffirm their outlook for the year provided on May 1st here. They talked about how the second quarter through June, they sold about 3 million shares of their Class A stock. That was something that investors were looking for from this name. That's been something that's been popular throughout this whole earnings cycle, as we know here. And also, again, that raise of Carvana stock to 150 from 135 from JMP here, just the latest in a slew of upward movements for Carvana from JP Morgan, from JMP, from Evercore as well. So looking like their ability to kind of reaffirm their outlook for the year was something that was viewed positively for the stock.
Yeah, and I think this outperform call, or really the fact that they raised their price target here, comes amid a challenging time for the industry as a whole. So they're seeing Carvana well positioned within that industry at that point. What the upside looks like, I think, is what many analysts are wrestling with. You've seen many here kind of recalculate some of that upward revisions in terms of where they see the stock headed here in the near term. But like you just saw on the screen there a moment ago, this is a stock that has been on quite a run since the start of the year. You're talking about shares really rallying just around 100%. So here we are trading today, still off about 0.4%, but holding above $106 a share there, Maddie.
All right, well, we are going to continue to cover all of your markets action ahead here, including some big new moves on the street when it comes to what we're seeing in global supply chains moving forward and the impact that that could have on the overall inflation picture. So we're going to be covering all of that ahead, so stay tuned. You're watching Catalyst.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action,
with step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is Market Domination.
Tune in daily from 3 to 4 p.m. Eastern.
Handful of tech names really driving the market's momentum since the start of the year. You've got big tech names like Nvidia, Google, and Amazon leading the way. But is the market's growing concentration, is that posing a risk here to the broader market? And is it still the best bet for your portfolio when it comes to big tech? So we want to bring in Dan Suzuki. He is Richard Bernstein's Deputy Chief Investment Officer. Dan, it's great to talk to you. So I guess just share with the audience here, how should we be viewing this concentration that we have seen among leaders within the market? Is there still reason to be betting on some of these larger tech names, or is the real opportunity elsewhere?
Well, Madison, it's great to be on your show. Thanks very much. I'm very excited. Yeah, I think we have a very core philosophy at RBA, which is that returns are greatest when capital is scarce. And if you think about the flip side of that, that may be more relevant right now, which is that risks are greatest where capital is crowded and concentrated. And I think that's very much the case today. In fact, you could argue that on a global basis, within the equity markets, concentration has never been greater than it is today. So, whether you're invested in the S&P 500, the Russell 1000, the Wilshire, 5000, or the ACWI Global Stock Market Index, it doesn't really matter, because if you're just your average investor out there, your portfolios tend to be dominated by a handful of stocks. And from a prudent diversification standpoint, there's a lot of embedded risks in there, especially when you consider that's the most expensive area of concentration as well.
Dan, as you know, I think the market is more than happy to look past the critical little details like how expensive a stock is, as long as the market continues to go up. Why should investors be worried about something like valuations when we are still seeing so much growth ahead, even for the biggest gainer like an Nvidia moving forward? Why does the valuation matter?
Yeah, you make a really good point, Madison. In fact, if you look historically, valuation is a terrible timing indicator. It basically tells you zero about what's going to happen to any given stock or the overall market on a 1, 2, even like a 3-year time horizon. It tells you very little. But it does tell you where the risks are. And when you combine those risks with the fact that, for the big cap tech companies, their earnings growth is actually decelerating. So if you look at the levels of their growth, they're very strong and they're very, much higher than the overall market. But those levels are actually starting to come down. Even in the case of any of those mega caps you mentioned, with those slowing earnings growth, I think what's critical is the rest of the market is actually seeing the opposite, in that earnings growth is going to be accelerating from here. So the acceleration that analysts are forecasting at the S&P level over the next 1, 2, 3, 4 quarters is not going to be driven by those mega cap names. It's going to be driven by the rest of the market. And I think that's actually quite exciting.
Dan, are you at all worried about what we're going to be hearing from the Fed over the next couple of meetings, or what you're talking about when it comes to earnings, when it comes to that investment growth that has really been the focus of the conversation so far? Is that going to really outweigh any sort of hiccups that we could hear from the bank?
I think there's a potential risk embedded in there. I personally think people overemphasize, the importance of the Fed, especially where we are today. I think, we have to remember that the Fed is a lagging indicator whose whole process is built around, targeting and managing to lagging indicators. If you look at unemployment, you look at inflation, those are official lagging indicators. So if you want to know what the Fed is going to do here, I think you really have to focus more on growth. And so it's really the growth angle that's going to be the driver of the Fed's actions here. And I think unless you see growth surprise meaningfully to the upside or meaningfully to the downside, the Fed's probably going to be, not really a huge factor for the overall markets. I think people should be more focused on what earnings growth is going to do. And again, that's where we're actually quite optimistic, because nothing we see in the data suggests that earnings growth is peaking out or rolling over. In fact, we think it could be accelerating further from here.
So you note that earnings growth is broadening. I'm curious about the degree to which some of the consumer weakness that we have been seeing showing up in earnings could be a headwind for consumer names in particular moving forward. I think about a McDonald's, a Starbucks. If we do start to see consumer weakness weighing on earnings, is that potentially a risk to that earnings growth?
I don't think so. I mean, my base case is that the consumer is probably going to continue to be one of the weaker parts of the overall economy. Now, that's the opposite of what we've seen before. So the pendulum's kind of swinging the other way. I mean, this time last year, we were in, if you think about the manufacturing goods side of the economy, that side of the economy was basically in a recession. And so that side of the economy is recovering. That's the bigger driver of corporate profits, and that's what's supporting, that acceleration that we're seeing. But the flip side is, that services and consumption side that's been very strong is starting to gradually slow from here. I don't think it's going to fall off a cliff, and I think the jobs report that we got last week kind of solidified that things are normalizing lower. They're kind of gradually slowing, but they're not falling off a cliff. But I do think that later in the economic cycle, as inflation, remains tight, the consumer has a lot more exposure to that part of the economy, and that part. And so I think those, are probably the areas you probably want to have a little bit less exposure to, where we are in the cycle.
All right, Dan, really great points. Thank you so much for joining us. We really appreciate it. That was Dan Suzuki. He is Richard Bernstein's Deputy Chief Investment Officer. Now, turning to some big news from Meta, the Supreme Court agreed to consider killing a multi-billion-dollar lawsuit that shareholders brought against the company. That suit accusing Meta of misleading investors about the data harvesting scandal involving Cambridge Analytica. Joining us now on this is Yahoo Finance legal reporter Alexis Keenan. Alexis, thanks for joining us on this developing news here. So the thing that I'm interested in is the potential impact this could have on corporate disclosures moving forward. So that's why I was very piqued by this story this morning. But what do we know about it so far, and what are you monitoring?
So the stage here is the Supreme Court just saying, we will take up Facebook's, Meta's request to try to get rid of this lawsuit. They don't think they should face a shareholder class action. They've already faced lawsuits, multiple lawsuits over the Cambridge Analytica data breach. And if you remember, 87 million Facebook users had their data taken back in 2016 in connection with the work that the company and the information it was sharing with Cambridge Analytica, that political analysis firm. And so that was all the way back in 2016 during Donald Trump's campaign for the presidential election. So Facebook wants it to go away for many reasons. They don't want to relitigate something that they would already have perhaps litigated. If you remember, they've already paid $725 million to settle another class action, another $5 billion fine to the FTC over this incident, and also $100 million to settle the SEC's claims that it misled investors back then. So what happened in the court system here is that at the district court level in California, that's the trial court, the judge tossed out that lawsuit. Now, it was appealed, though, and brought back by these shareholders, and it went to the circuit court, and the circuit court said, you can go ahead with this action. So that's what this is over, whether or not the action will get to stay. These shareholders argue that the stock fell not once, but twice on reports around Cambridge Analytica. So like they want to say, the shareholders want to say, well, the fallout from that had multiple repercussions for us, and they want to have their day in court to talk about that. So Facebook, I have seen, told Reuters that the Ninth Circuit's ruling, they say, would force public companies to inform investors about past incidents, and they say that should not be the standard.
All right, a story that we will continue to track. Alexis, thanks so much for breaking that down for us. Well, coming up, we're going to dig into the snap elections being announced in France for the end of the month, the ultimate impact that this could have on global markets, and ultimately what this could mean for trade and supply chains. We've got that for you next.
European markets having some pressure today after French President Emmanuel Macron's surprise decision to call for snap elections after his centrist coalition was trounced by the far-right party. Macron's announcement is yet another example of how global politics can have resounding impacts on both markets and the economy. For more, we bring in Marissa Adams, HSBC America's head of global trade solutions, here in studio with us. Marissa, thank you for being here. We were obviously just talking about the impact of this election, and what kind of stood out to me is that Macron's loss was sort of priced in, but the snap election decision was the big surprise. And it makes me wonder if that is what's going to define this election cycle that we're seeing across the globe, some of these surprises that are more difficult to price in. What do you think of that?
And thanks, Madison. I think one of the interesting things is that in over 60 countries this year, there will or there has been an election. So it's a historic election year across the globe. We've obviously seen France overnight, the UK a few weeks ago. We've seen the results of Mexico as well as India. And one of the things for sure is that trade continues to be a huge topic on the campaign trail. Now, some of that's due to protectionism, nationalism, other focuses. And one of the things that we advise our clients at HSBC is finding ways to decouple their supply chains from geopolitical risks. So we've recently issued a report around supply chain resiliency and geopolitical challenges. So given all the multipolarity, obviously we can see that supply chain challenges remain regardless of which market you're in. So looking at how they can find ways to de-risk through diversifying their supply chain, but also taking into account multiple scenarios. So we're not here to predict what might happen, but help them through that.
And talk to me a little bit more, because I had the report pulled up right here, just in terms of what you just said at the end of that answer, ways that they can de-risk some of their operations, those that have been successful or those that you think are really among the leaders in best preparing for what is a very uncertain time. What are they doing?
So a few things, and I think I'd actually take a step back by saying that before the COVID-19 pandemic, the singular goal of supply chain was cost, right? So trying to reduce costs, improve the bottom line. But the COVID pandemic was really a wake-up call to say, actually, I have risk in my supply chain. I don't necessarily know the second or third tier of my suppliers. So things that companies can look at is, firstly, I think, taking a real big deep dive into their supply chain. Where do they see risk? Are there certain suppliers that they have a concentration on? Or are there countries where potentially there's more risk around it? I think one of the other things that we see is we see a trend towards proximity, moving supply chains and parts of that a little bit closer to home. What that can do is obviously give you a bit more security in terms of where and how you can get your goods, reducing costs perhaps on the supply side and the shipping side, but actually sometimes that cost of production is harder closer to home.
So there are so many things you just said I want to follow up on, but let's start on the pandemic. Have we completely re-normalized from that in terms of supply chains, or are there still areas that are still struggling to recover?
So I would actually say that we're in a new era. So I don't think that there is a normalization anymore. I think that what companies are now facing is that supply chain disruption is the new norm. We went from a world where goods were just in time, and now we're looking at people going just in case. And that's really changed a lot of companies' balance sheets. They're having to hold more inventory, they're having to prop up their suppliers. And one of the things that we do at HSBC, as an example, is providing supply chain finance off the back of sort of US buyers. Now, some of that is to provide finance to the suppliers, where in the current inflationary environment with interest rates, they may not have the working capital themselves to absorb that cost. But also what it tends to do is actually tighten those supplier relationships. So if you're actually providing that supply chain finance facility, you're helping that supplier to succeed, and in some ways de-risking your own supply chain to have that security.
Yeah, and as you take a look at some of the sectors that have been most affected, obviously I think one of the sectors that is top of mind for many investors out there is what's happening right now amongst chip makers, specifically within the semiconductor industry. What are you seeing there? And then just the ultimate impact that this is going to have on these companies for investment portfolios. What should they be keeping in mind?
Yeah, and it's a really good question. And I think there's sort of three things that I would say that investors need to look out for when they're looking at companies they're investing in. So number one, is the CFO, our senior leadership talking about supply chain resiliency? If you look at the reports, there's sort of been, we've got some stats around the increases up and down around supply chain resiliency. So are they focusing on both the risk and the cost? Second thing is they should be looking, does the company have concentration in key markets or key sectors? And you bring up semiconductors, which is a very common challenge at the moment, where a lot of the production is in Taiwan. They're trying to move production here into the United States, but actually that's not a snap decision. It takes 5-10 years of investment. So the third thing I'd say that they should be looking out for is that, are the companies talking about investment into infrastructure, investing in their supply chains and that diversification? And I think that's something for them to take a look at as they're looking at companies they're investing in.
Well, that makes me think about the China of it all, and I'm curious what you're telling investors about the potential China risks. Whenever we have CEOs come in who are working here in the US and also globally, I love to ask them how they kind of walk the tightrope of dealing with the US and China amid this increased tariff war. What are you telling clients about that?
Look, I think the thing that we sort of say to clients is that supply chains are complex, and even when things are produced here in the United States, there's a number of different components that are produced in Asia, in Europe, and other markets in the world. So what we're trying to talk to our customers about is, one, looking at the risks holistically. So don't just look at one category of your products, but do you have a geopolitical risk in one country versus another? Is there a risk from a transport aspect in another country? So we tell them to look holistically at the risks rather than focus on a country by country basis.
What about inflationary pressures? Is this going to worsen the situation? Is this going to prolong some of the challenges that we're seeing around the world?
It's definitely prolonged some of it from a supply chain perspective. And I go back to the fact that if you're a large corporate, you can typically get 5 to 10% more on your facility. But actually suppliers in some of these local markets, if the cost of inputs goes up 5 to 10%, they might not actually have that financing to supply that. So that's why it's really important for companies to really look at their suppliers to see how they can protect them and help them in this inflationary environment.
Thank you so much for joining us, Marissa.
Thanks so much.
This was a great conversation. Really appreciate it. Again, that was Marissa Adams, HSBC America's Head of Global Trade Solutions. Well, coming up, we're going to get your key takeaways from markets as we head into the rest of the trading day here. You're looking at a mixed bag when it comes to the major indices. Some declines in the S&P 500 and the Dow, the Nasdaq still moving to the upside. We'll cover all that and more. This is Catalysts.
Let's get right to our key takeaways for markets today. And one of our takeaways is that Wednesday's inflation print. Now, we spoke to Jason Furman. He's Harvard Kennedy School of Government professor and former Council of Economic Advisors chairman under President Obama. We asked him what his expectation was for that CPI print, also from the Fed over the coming months. We've got the Fed meeting and Fed decision on Wednesday. Here's what he had to say.
I doubt they're going to cut rates until December. Even if it's a decent CPI print, the problem is, the good months it's at 2%, the bad months it's way above 2%. That means it's averaging out to a decent amount above 2%.
So, Manny, from all of our conversations here with economists, with strategists here over the last 2 hours, my takeaway is there's still a lot of debate surrounding what the Fed is ultimately going to do between now and the end of the year. But I think there is agreement that some of these projections are going to change. I think it's the degree of that change is what is still being debated up until this point.
Yeah, and I think it's interesting. Jason Furman had noted that the CPI data is not going to be able to work into the Fed's decision, of course, but we are going to be getting that pressure from Fed Chair Jay Powell. And I think that his tone could be changed. Obviously, he has the time to do that between the data that we get from CPI and his commentary. So how dovish he's able to remain, he's always a little bit dovish. So can he continue to do that given whatever data we get from the CPI, I think will be a critical indicator of where the Federal Reserve is thinking moving forward and the degree to which we can anticipate potentially a September cut, given that November is a little bit tricky with the election.
Yeah, and also many of the strategists telling us that the market could be very volatile on the heels of Wednesday's action too, given the fact that we do have CPI and the Fed decision in the same day. So big 5 days for the markets.
Big 5 days. And lots of tech news too. So we'll be covering all of that here for you on Catalyst. But coming up here, we have Wealth dedicated to all of your personal finance needs. Our very own Rochelle Akufo is going to have you for the next hour, so stay tuned.
Welcome to Wealth. I'm Rochelle Akufo, filling in for Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and tricks you need to grow your money. On today's show, Apple is hosting its annual Worldwide Developers Conference. We'll explain what it means for you and your devices. And it's a big week of data on tap. On Wednesday, Wall Street will be watching the latest read on inflation as well as the Fed's decision on interest rates. How should you position your portfolio? We'll ask a strategist. Plus, Friday's jobs numbers came in much higher than expected. We're going to talk to a career coach about the best tips and tricks for your job hunt. All right, let's kick things off with Apple fans or perhaps Android hate watchers. Pay attention because we could be hearing about some new gadgets and software from the company in just a few hours. Apple's annual Worldwide Developers Conference kicks off today at 1 p.m. Eastern, that's 10 a.m. Pacific, and our very own tech guru, Dan Howley, is on the ground in Cupertino, California with the latest. So, Dan, what can we expect?
Yeah, Rochelle, I'm here at Apple's headquarters. This is kind of that spaceship that everybody talks about for where Apple's basically everything happens for them. And so what we're expecting today is all about AI. Essentially, Apple's going to debut their AI strategy, what that means for consumers and how it'll be implemented across their product. Now, according to Bloomberg's Mark Gurman, there'll be a new type of software called Apple Intelligence, AI for AI, obviously it makes sense. And it'll allow people to do things like quickly reply to text messages, do summaries for websites in Safari, quickly reply to emails in the Mail app, and most of all, make Siri smarter. The original voice system is going to get a big upgrade, and so that'll allow it to do things like control individual pieces of apps rather than just saying, okay, Safari, or Siri, play Spotify or something like that. You'll be able to do more with Siri overall, and that's a good thing. It means that we'll be able to get a lot more capabilities out of the software, and it'll basically revive something that's kind of languished for a while. It's not just going to be on the iPhone. It should also be on the Mac. It should also be on the Apple Watch, the iPad, you name it. It's going to be kind of spread out across the entire ecosystem. And then beyond just the artificial intelligence aspect, there's supposed to be some upgrades to iOS itself, which will allow you to finally reconfigure the home screen. I know it sounds kind of like a silly one-off thing, but you no longer will have to use the grid that we've used since the iPhone launched in 2007. You'll be able to rearrange things as you want, change the color of icons, make your iPhone more yours than before. Now, as you said, Android's been able to do pretty much all of this stuff already. They Google previously launched their own AI capabilities. Samsung has done the same. But for Apple, this is a really big moment. Obviously, Google's been a part of the AI race. Microsoft's been a part of the AI race. Meta, Amazon, you name it. And this is going to be Apple's entry. So the hope is that it gives a lot more capability to consumers. It makes things more exciting for them. And then that could mean that they'll end up selling more iPhones. So we'll have to see how the compatibility works, whether this is going to work with older iPhones, whether it'll work with older Macs, or whether you'll have to go out and buy a new phone come September to make sure that you can use all of this new software.
Well, certainly a lot of people waiting to see what Apple will do with this AI push. Appreciate you so much. Our very own Dan Howley with that preview. Well, as Apple fans are waiting on the edge of their seats for info on the latest iPhones, iOS update and more, here with the biggest questions Apple has to answer for customers is Philip Michaels, Tom's Guide Managing Editor. Thank you for joining us this morning. So Tom, obviously we remember the days of old where there'd be some huge hardware launch. Not expecting that this time around. What can customers actually get excited about here?
I think the big thing to get excited about this time around, in particular, will be the preview of iOS 18. The AI features that Apple is going to talk about today are going to touch across all the various platforms that they have, the iPhone, the Mac, even the Apple Watch. But it seems like the brunt of the features are going to be mobile focused because, of course, that's where Apple sells the most products these days. And the thing that I'm most interested in seeing, and I think Dan mentioned it, was the compatibility issue, whether older iPhones are going to be able to fully support these features or whether Apple is using this opportunity to maybe push us towards upgrading our iPhones in the fall.
And if we do potentially see an upgrade in some of these products that will force us to buy a new product here, do we know what sort of price range some of these AI-enabled features will come with?
I don't think the AI itself is going to cost anything. I know that there is talk of subscription fees, particularly on the Android platform, but I think this is going to be something that Apple bakes into its operating system, and really all that you're dealing with is the cost of the new phone, which using Apple's current prices ranges between $799 to $1199, and that's a one-time purchase.
And so, Philip, are you wondering why we're not seeing any hardware with this announcement or anything about the iPhone 16? When are customers actually going to see that?
So Apple, while Apple is mysterious, Apple is very predictable. They like to hold off their phone hardware announcements until the fall to maximize sales, particularly around the holiday quarter. WWDC is a developers conference. And really, the audience that Apple is typically trying to reach are the people that build its apps. So you don't often see a lot of hardware at this particular show. To the extent that they have done hardware in the past, it's been either Mac focused, the machines that these developers can build their apps on, or occasionally an iPad. But the phone announcements are very strictly in the fall.
And so then, as we look at where the AI-capable and AI-enabled smartphone market is headed, there's some recent data from Canalys, which shows that these AI-enabled smartphones are expected to make up 54% of the global smartphone market in 2028. And that's actually going to be driven by consumer demand as well as some of these advanced chips. So from a customer perspective, do you think Apple is going to lose its edge if it doesn't come out, though, with some really impressive hardware to really take some of this market share away from your Samsungs and your Googles?
I wouldn't worry too much about Apple losing market share. They have a very loyal audience. But it is something that Apple is going to need to address, given how the emphasis that rival companies like your Googles and your Samsungs are placing on AI. And I think the chipset is really going to tell the story. We've seen Qualcomm with its Snapdragon chips really put an emphasis on its neural engine. We've seen Google with the Tensor chips in its Pixel phones, that's been a major focus. Up until now, Apple with its A-series chips that power its smartphones, the emphasis has really been on performance, and I think we're going to see more of a focus on neural capabilities going forward.
And so then when you look at some of these additions that we're expecting with the iPhone 16, if you're just a consumer looking to see some sort of big announcement from the WWDC, are they going to be disappointed then if it's really just more so about the software here?
I think that people who've been Apple customers for a while kind of know what the game is, that this is where Apple previews its software updates for the year. And keep in mind that these updates are going to be available as public betas in a couple of weeks' time. So if you're really excited to see what's in store for your iPhone, you'll be able to sign up for a public beta of iOS 18, download it onto your phone. I'm not sure I'd do that right away because reports are that the early version might be a little bit buggy. But I don't think people are going to be too disappointed, especially since Apple just a month ago released some new iPads. We're going to have the new phones in the fall. This is typically a time to focus on software.
And certainly a precursor there as people can sort of think about what they might want to purchase in the fall as well. Appreciate you joining us this morning. Philip Michaels, Tom's Guide Managing Editor. Thank you so much.
Thank you for having me.
All right, coming up, we've got a big week of economic data to wrap our heads around. We'll break it all down with a strategist who can help you position your portfolio. Stay with us. We're nearly 2 hours into the trading day this Monday. Let's check up on shares of Nvidia, reversing earlier losses and trading higher here, looking at about $121.98 there. That's after opening the session on a split adjusted basis. So shares are now going for around $120 each, as you can see there. That does make them more affordable for investors, but does not affect the actual value of the company as a whole. Important to keep that in mind. Now, Nvidia approved a 10-for-1 stock split, which they announced in their first quarter earnings report back in May. That means on Friday, each share that was owned by an investor split into 10 shares. So if you owned 1, you now have 10. If you owned 10, you now have 100 shares of Nvidia, and so on. Now, the stock split comes after the AI giant's market cap hit $3 trillion last week. It has since dropped just slightly below that milestone figure that did have it briefly overtaking Apple. Well, after Friday's jobs report blew past expectations while the unemployment rate ticked up, another round of economic data is on deck for investors to digest. And that includes the Fed's interest rate decision and remarks around the path of monetary policy on Wednesday. Here with more on how to best position your portfolio ahead of this big week, we have Oh-Sung Kwon, Bank of America Director and US and Canada Equity Strategist. Thank you for joining me this morning. So, I saw that in your latest note, you say a no landing scenario is back on the table. What does this mean for your portfolio if you're trying to really sort of gauge where the Fed is headed from here?
Yeah, so thanks for having me today. And obviously, after the blowout jobs report that we saw on Friday, the no landing debate, we believe that is back on the table. And we don't think that's necessarily bearish for equities. I mean, so far this year, up until, I want to say a month ago, that's been the macro environment for equities that, you know, the risk of reacceleration was pretty high. The macro data continued to surprise to the upside, yet equities continue to chug along. Rates were rising, but equities can withstand higher rates as long as, you know, growth is staying strong. As long as growth is staying strong, I think higher inflation and higher rates can be withstand by equities.
And of course, we are going to get CPI, PPI data and consumer sentiment also throughout this week as well. What does this mean if you're an investor and you're watching this data, perhaps, you know, given what we saw against that backdrop of the strong jobs market there, how should you be positioning yourself? What should you be focusing on when you head into this week?
I think the risk to equities is still skewed to the upside. The reason why I say that is because the worst case scenario of a weak jobs report plus hotter CPI, that has been avoided after the NFP print last week. If CPI were to soften on Wednesday, that's basically the best case scenario for equities. It's basically risk on. Growth is strong, but inflation is coming down. That's basically the immaculate disinflation that we saw last year. And we all know what happened to equities last year. So I think, you know, investors might want to position for that potential upside in equities. And I think that's really the pain trade. I think the pain trade is still to the upside, especially in cyclicals. And if inflation comes down from here, despite strong growth in the economy, that really positions well for a cyclical upside in equities.
And for people who perhaps might be tempted to have a knee-jerk reaction if they do see another report that's really off what predictions are showing there, what sort of time horizon should people be looking at to really get a real sense of the inflation picture, something that we know is something that the Fed does? They don't just go by one set of data. What sort of time horizon should people be looking at?
Yeah, I mean, it really feels like the market's focused on CPI print on a month-to-month basis. But, you know, you got to look at the bigger picture. You got to zoom out and look at the trend of inflation. And so far, it's been coming down. It's, you know, we sort of stalled after that big disinflation that we saw last year, but we're not accelerating right now. And as long as inflation doesn't re-accelerate and growth is still strong, I think equities can work to the upside. And if macro data were to slow going forward, you know, that's essentially what we saw over the past couple of weeks, that, you know, macro data started to surprise to the downside. If that's the case, and I'm not talking about growth falling off the cliff, it's just simply normalizing to trend growth levels, that should also result in inflation coming down at least a little bit. I mean, inflation at the end of the day is supply versus demand. Supply side is still, you know, it has gotten a lot better. It's more about demand going forward. And if demand were to moderate, basically to, you know, to the trend growth level, normalizing to the trend growth level, then that should result in inflation coming down as well. And that's essentially the bull case scenario of soft landing that everyone wanted to see heading into this year, as well as the Fed. So I think there are many ways that equities can win.
So let's talk sectors that you like the look of in this environment. Where's a good place to position yourself?
I think financials looks very interesting. I mean, it's very beaten down, and positioning, everyone hates financials after what happened last year. But these banks are very well capitalized. Fundamentals are very strong, and if growth is strong and corporate profits are accelerating to the upside, I think the macro environment is still pretty favorable for financials. And if the Fed is done hiking, then that should alleviate some of the deposit pressure that financials has seen so far. But the back end of the curve is likely going to remain elevated going forward. I think that's the secular force in the market. And if that's the case, that's essentially pricing power for financials. So I think I like financials. I like energy as well. I like commodities overall.
And for people who are wondering if they've missed the boat on the tech rally, is it too late at this point when you look at where prices are?
I hate to say, but I think so. I mean, tech has rallied so much. Positioning is very crowded. Valuations are pretty expensive. And that's been sort of the consensus trade over the past year and a half or so. And if you think about what really drove tech performance over the past, 2+ years, I think it's really about earnings. I don't think it's necessarily about the macro environment. Because heading into 2022, everyone was worried about the hiking cycle and how higher rates are going to play on long duration equities. And essentially, that's what we saw in 2022, that tech underperformed massively versus the S&P 500. But if that were to be the case, if rates were really the big driver, then tech should have underperformed last year as well as this year. Obviously, that wasn't the case. I think it was really about earnings. Tech earnings underperformed the entire year in 2022, and it bottomed in around March of last year. And essentially outperformed in terms of earnings since then. And that's essentially what happened for the stock performance as well. Going forward, what's interesting is that tech earnings growth is likely to decelerate, especially the Max 7, whereas non-tech stocks are expected to see accelerating earnings growth going forward. So we think that you could get cheaper growth in non-tech sectors, more cyclicals, more commodities and value-oriented sectors of the market.
So certainly time to shift that focus from the shiny objects that they have in tech. Appreciate you taking the time to join us this morning. Oh-Sung Kwon, Bank of America Director and US and Canada Equity Strategist. Thank you so much.
Thank you.
All right, coming up, entering the job market after graduating college is not easy. We speak to a career coach on how recent grads can land their dream job. That's right after this break. Stay with us. High school seniors are graduating, and with college on the horizon in just a few months, many are still wondering how they're going to pay for it. FAFSA delays are adding uncertainty on top of stubbornly high interest rates and the enormous cost, all factors for teens seeking higher education. Here with tips for the college bound is Jennifer Finetti, the Director of Student Advocacy for Scholarship OWL. Thank you for joining me this morning. So first of all, break down the ongoing issues that we're seeing right now with these FAFSA applications.
The FAFSA is brand new this year, and as a result, there were some technical glitches when the FAFSA launched back at the end of December. Those glitches have now been resolved, but it took some time, and so students and parents were left really hanging, waiting for financial aid offers. Many of those offers didn't start coming until the end of April, which is really late, and it made it very difficult for students to be able to quickly make their admission decision. Most students have now made their admission decision. Most of those financial aid offers have now been received. But it really was kind of a pins and needles situation, unfortunately.
And so in terms of the domino effect, which students have been most affected by this?
You know, I think any student that was really counting on financial aid to afford college was obviously affected by this. Certainly low income and middle income students, I think, were affected the most. But, you know, the vast majority of students are still relying on financial aid to help pay for college. The cost of college is so high that even upper income families are, were hoping to get some financial aid for their child.
So for people who aren't sure on the status of their FAFSA application, or they're worried that at this point it perhaps still hasn't been approved yet, what should they be doing?
So first of all, the financial aid deadline for the FAFSA is June 30th. That's the federal deadline. So any students who have been kind of sitting by and kind of waiting for these glitches to resolve themselves, you only have a few weeks left now to apply with the FAFSA. So if you haven't submitted, you should do that right away. For any students still waiting for financial aid offers, those students and their parents should be following up directly with the financial aid offices of the colleges that they are considering. To see what is going on. Is there something that's missing from their file that's causing the delay, or simply to prod the financial aid office and get those offers in?
And for those that have received offers, but it's perhaps less money or less support than they were expecting, is there a way to negotiate that package?
There can be. If the student has applied to a private university or a out-of-state school, there is some flexibility typically in those financial aid offers. So those students can contact the financial aid office and say, hey, you're my first choice school. I really would like to attend, but, is there something we can do here? Are there more scholarships I could qualify for? And in some cases, those schools will go ahead and offer something to the student. If you are focusing on an in-state public university, there isn't as much flexibility there, though. But even in those instances, if you think that your FAFSA results are wrong, if you feel that you should have been offered more aid than you were, it's worth following up just to check and make sure your financial aid offer is even correct.
And so in that calculation, then, when people are trying to figure out just how much debt they need to take out, because obviously it's not just the tuition, you have books, you have other things to consider. How should they be calculating that?
I always tell students to try to avoid debt, right? That's the first choice. If you must take on some amount of student debt, I recommend only taking out federal student loans. Do not take out private loans. I discourage parents from taking out Parent Plus loans or other loans to help pay for college, because it's so much harder then for parents to be able to save for their own retirement. If they have additional children going to college later on, it just makes it more difficult if parents are taking on debt to help pay for college as well.
And in this final stretch ahead of the deadline, what's the biggest mistake you tend to see students and families make in this last scramble for financing?
The biggest mistake I see is that students stop applying for scholarships, typically once their admission decision has been made. They get excited. They think, okay, our deposit's been paid. I can now focus on summer activities. I can focus on decorating my dorm. Really, though, these students should be focusing on applying for scholarships all summer long and also all year round. A lot of students and families don't realize that scholarships are available year round. On the Scholarship All platform, we always have over $500,000 in currently available scholarships, no matter what month of the year you're applying. So you're going to miss out on those opportunities if you don't apply. And also, you can earn enough scholarships to perhaps avoid taking out all federal student loans. And then I also tell students, please work full-time during the summer, part-time during the school year. Sometimes parents will say, being a student is your job. You don't have to work while you're in school. I disagree. If you are a student, you can work part-time, 10 to 15 hours a week, not only to help pay for college, but also to get really valuable job skills so that when you graduate from college, you're not only going to have your degree, you're also going to have experience that you can use to get a job.
Yeah, that was certainly the motto in our house. We were certainly all told to make sure that we worked during college as well. Appreciate you breaking down all those great tips. Jennifer Finetti, Director of Student Advocacy for Scholarship Owl. Thank you for taking the time this morning.
Thank you.
Well, 20% of Americans have student debt. That's according to the Education Data Initiative. And that could put a strain on people's wallets and their ability to contribute to their retirements. But there might not have to be a trade-off. To break down how you can grow your retirement and pay off your student loans, Yahoo Finance's very own Kerry Hannon is here. So, Kerry, what is the formula here? Because a lot of people are wondering, is it all about, one for the other? But you're saying they don't have to trade these off.
Yeah, this is a big deal. This is kind of the perk of the year, I think, from employers once they get going with this. President Biden signed this legislation into law, and it was Secure 2.0. It is now starting this year. This is effective that if you have a 401k plan at work and your employer gets this up to speed, that they can match your student loan payment into a retirement account for you. So they consider the amount you're paying on your student loan as a contribution to your retirement account that they in turn will match for you up to, the typical match for an employer is 4% of your salary to 6%. So it has to be under that amount, whatever the percentage of your salary. But if, say, your student loan payment they usually run between $200 and $300 a month. So you can take that as they consider that part of your retirement contribution. And you can still add more into it yourself, of course. But this is a huge help for people, especially early in their careers, who are so stretched, like, I can't possibly save for retirement because I'm trying to pay off this student loan. And in fact, Betterment at Work did a survey that said, 64% of workers they talked to said that this was, having to pay off their student debt really has a serious impact on their ability to save for retirement. So, Rochelle, this is really, I think, a really cool thing. It's a great twist. And it can really, really help people get started on retirement saving as early as possible.
So for Kerry, for people who are saying, look, there's no such thing as a free lunch, what are some of the drawbacks here that people should also be aware of?
Well, yeah, with everything, there's sort of how do you go about it? Here are the concerns that I'm hearing right now. And of course, I want to remind you, this is just rolling out this year, but I'm telling you, it's a great thing ultimately. But people that I talk to, the experts, say there's some concern that people may hold off on saving as much as they could save for retirement because they figure, oh, good, this is being taken care of by my student loan match, by my employer. I don't have to save up to that full percentage of the employer match. Please do. I mean, you need as much as you can. So if you can, keep saving in addition to that. So you don't want people to get complacent about that. And the second thing I heard is that, hey, people may actually start dragging their feet on paying back their student loans as quickly as they possibly could because they want to take advantage of this employer match. So they think that's a real great thing. So why not keep the loan stretched out just a bit more so they get the match? But really, I think most people, and it's a great way for companies, employers to attract workers, young workers particularly, and retain them because this is really a terrific benefit that helps people who feel stretched about can they save for retirement? Yes, you can.
And certainly every little bit helps, especially now. Appreciate you, as always, our very own Kerry Hannon.
Thanks.
Well, over 1 million people received their bachelor's degrees last year, and the majority of them had jobs within 9 months of graduating, according to the Bureau of Labor Statistics. So to break down how this year's cohort of college grads can land their dream jobs, Fran Berwick, Spearmint Coaching CEO, is here. Thank you for joining me this morning. So, people are graduating, they're wide-eyed and looking at this job market here. There's still a tight labor market here. What is the biggest mistake that new graduates make when they're first entering the job market?
I would say overall, the biggest mistake new grads make is not determining a goal, not creating what I would call a target job description. There's lots of data to show that people land a job more quickly and more successfully when they have a bias towards action and a goal-oriented focus. The other thing that I see quite a bit is that they lead their search completely online rather than using their network to focus their plan forward. And mostly, and you could understand why this Gen Z graduating class of 2024 is graduating into an anxious environment. And I find many of them are nervous about actually making mistakes in the job as they apply towards jobs. And I like to say there are no mistakes here, and lead towards a bias of action.
So Fran, let's break a couple of things down there. So if you're a new grad and you're thinking, okay, my goal, should it be a salary amount? Should it be this is the kind of company I want to work for? Should it be this is the CEO I want to work for? How should they gauge that?
Right. Well, hopefully, like your last guest mentioned, the work experience or academic experience they've had in college will have led them to understand what I call their unique operating system. Their strengths and innate strengths and skills and experience, and what that may lead up to and look like in the world of work. Most universities have great resources in college career centers. So if you don't understand what your playlist would look like, in the actual job market, I would suggest that you use your resources to identify what that might look like as an end result, if that makes sense.
That does make sense. And something else that you touched on was networking. A lot of people, when they're fresh out of college, the first thing they do is perhaps, email people on LinkedIn, trying to get a mentor. What are some of the ways they should really think about networking if they feel like they really don't know anybody in the industry they want to enter?
Look, I think networking, there's two things. I find for my clients, once they have an understanding, Rochelle, of what I would call their elevator pitch is, what their professional value proposition is, the whole concept of networking gets a whole lot easier because they understand what it is that they're talking about when they present themselves. When I sort of do a deep dive with recent grads, they're often surprised to understand that they can network or express their goals with professors, with previous employers, with friends of family, and with the understanding that it may not be them who can offer you a job immediately, but they may know someone who could refer you to someone who may know somebody. So the idea here is having as many conversations to exponentially increase your reach and your message, and ultimately find someone who's going to need your skills and services.
And you mentioned this about sort of some of the offline things that people aren't doing and they're just sort of focusing on an online search. What is the best mix of that? Is it sort of an old school cover letter mixed with some of the newer things we're seeing with AI and really landing that dream job? How should they approach it?
Right. I love that question. I think AI is a great tool, but there is lots of data now to show that one of the quickest, most advanced ways of actually landing a job is to take your resume off that algorithmic hamster wheel and get in front of a real set of eyeballs, a real person in HR and hiring. You do that through warm contacts. So for example, the blend I like to use is if my clients or anybody listening has a target list of top 20 companies that they would love to work for. Obviously, you should be applying to every role you see online, but you should also be working on your LinkedIn contact list or your network contact list. So when a job comes up at Amazon, Google, and the advertising agency of your dreams, somewhere in healthcare, you're already in the mix. You know somebody who could maybe even make a referral fee by recommending you, through HR contacts. And I find it's that combination, that 1-2 punch, the online submission and the warm contact that really gives people an advantage.
Well, people certainly should be taking heed there. Lots of great advice. Appreciate you taking the time this morning. Fran Berwick, Spearmint Coaching CEO. Thank you so much.
Thank you so much.
All right, we have much more on wealth after the break. You're watching Yahoo Finance. According to the National Gay and Lesbian Chamber of Commerce, there are over 1.4 million LGBTQ business owners in the United States, contributing approximately $1.7 trillion to the economy annually. For more on the impact of LGBTQ plus businesses on the U.S. economy, we're joined by Rhett Buttle, Public-Private Strategies founder and principal. Rhett served as the National Business Advisor in President Biden's 2020 presidential campaign. Thank you for taking the time to join us this morning. So, talk about how these businesses are faring this year and really the sorts of resources that have helped fuel this growth.
Well, happy Pride Month. As you know, this is a month where we celebrate contributions of LGBTQ Americans all across the country. And one of the specific pieces that is so important that the story doesn't get told very often is what a critical fabric they are to the small business and entrepreneurship economy. So the American economy, as we all know, is powered by small businesses. They're the backbones of our communities. And as you heard, LGBTQ plus businesses are a huge part of that economic fabric, not only in the businesses that they start, create, and run, the people they employ, but also the LGBT consumer is a massive consumer, obviously not just in June during Pride Month, but all throughout the year.
And looking at some of the data here, the LGBTQ community is spending more than $917 billion every year on goods and services. Where does that money tend to flow to?
Well, look, a lot of LGBTQ consumers are focused, like many consumers, where they live, focus on supporting the small business community. Just like everyday Americans, they're a powerful force for the economy. Many of them are investing in their local communities, buying goods and services for their family, but also a lot of, very important specific industries. Travel and tourism tends to be a huge part of where the LGBT community spends their dollars. And like I said, many folks in the LGBT plus community are very entrepreneurial. And so seeing them start and grow their businesses is an important part of this economic impact.
And looking at the demographics here, in terms of how young some of these business owners and entrepreneurs are, walk us through that and what they're really tapping into to grow their businesses and really also spend within the community as well.
Yeah, this is actually a trend we're seeing with a lot of business owners. They really identify their identity really leads where they go to for tools, tips, and resources. And so earlier in the segment, you quoted the National Gay and Lesbian Chamber of Commerce, the National LGBT Chamber, which is an amazing resource for LGBT business owners. And they really provide the sort of community and support that small business owners need in order to grow their businesses. We've seen a lot of really positive steps from the Biden-Harris administration. For the first time, the U.S. Small Business Administration has really celebrated Pride and provide tips and resources to LGBTQ plus business owners, really honoring and recognizing the important contribution that they make to this economy. And we see this actually across a lot of different trends. So not only in the LGBT community, but also in the African-American, Latino, Hispanic community. Folks are really dialing into the African-American Chamber of Commerce, the Hispanic Chamber of Commerce, and we've seen that growth with LGBT chambers of commerce across the country. And there's over 20 LGBT chambers of commerce at a state, local, and federal level, really helping LGBTQ entrepreneurs do what they do best, which is grow jobs and give back to their community.
And sometimes the resources are there, but people don't necessarily use them. So Rhett, tell us about some of the programs and the efforts in place to help LGBTQ plus business owners grow their companies or ventures, and perhaps some of the ones that are underutilized that they should really be tapping into.
Yeah, so I would start with talking about the National LGBT Chamber, which is an important part. They can help businesses get certified so that you have that distinction. That really unlocks new opportunities in corporate America. They also serve as an important advocacy voice for business owners at a state, local, and federal level. We're seeing more and more states and local governments work with the LGBT community to help get LGBTQ businesses in their supply chains. It helps them make sure that they're really meeting the community where they're at, as well as helps grow these businesses. So that's really important part of it. I think another underutilized resource is the U.S. Small Business Administration, which has really created a number of tools and programs to really meet business owners where they at. When you're starting a business, sometimes it can be often confusing. Where do I start? How do I get a loan? How do I do my taxes? There's a lot of really good work going on at SBA.gov where business owners, LGBTQ business owners, but really any business owner can go and help get some of their needs met.
And also looking at the data here, looking at the majority of LGBTQ plus small businesses more likely to be owned by women and also be immigrant owned as well, especially when you think of an election year. So many topics on tap here. What should people be aware of when they think of the businesses and the demographics within them and how to support them?
Yeah, so LGBTQ plus businesses are a huge part of the economy, but women, and we see this across all demographics, women, whether it be Latino women or African-American women, LGBTQ women, are really starting to become more entrepreneurial. A lot of that is because, women are in many ways looking for more flexible work arrangements, but they also tend to be amazing entrepreneurs and they see needs specific in the market that is really, really important. We see the same with immigrants who have come to this country. Many of them are wanting to participate in the American dream. They see specific needs that others might not see in the market, and they go out and start a business. Starting a business is no small feat. It takes a lot of hustle, and so it's really impressive to see all of these folks go out and really, start these businesses, which are such a critical backbone of the American economy. 2 out of every 3 Americans are actually employed by a small business, and so keeping this job engine running and providing tools and resources to make sure it's running well is an important thing that we all must be focused on.
Indeed, and happy to have you on here to lay out some of those resources for us. Rhett Buttle, Public-Private Strategies founder and principal, thank you so much for joining me this morning.
Thank you. Happy Pride Month.
Thank you. All right, coming up, with the housing market unaffordable for many, renters are staying in one place even longer than ever. We'll break down the impact when we return. Owning a home is the quintessential piece of the American dream, but a number of people are renting longer as the housing market remains out of reach for them. The latest data from Redfin shows that 1 in 6 renters have stayed in a rental property for 10 years or more in 2022. That's a jump from a decade ago. For more on what's happening in the rental market, let's bring in Yahoo Finance's Danny Romero. So, Danny, give us the lay of the land, as it were.
Rochelle, people are staying in the rental market longer, and there are several reasons behind this push. Really, the first one is that renters feel like they're priced out of home ownership. If we take a look at the median sales price of a home, it has nearly doubled in over a decade. That's one of the reasons. Mortgage rates are also still really high. They're hovering near that 7%, which means high borrowing costs, pushing more people to the sidelines. A second reason is that rents have also gone up too. We can't forget about that. Rents have jumped more than 30% since 2019 to 2023 nationwide. That's according to Zillow and Street Easy data. So that's really preventing people from moving from place
to place so quickly. The third reason is that renting has become a lifestyle, and we can really thank the pandemic there, especially with remote work. People are a lot more career focused, and so that allows also people to move around if they want to. The fourth reason why people are staying in the rental market longer is that there's not enough homes for sale. Their homeowners are really not incentivized right now, given the fact that mortgage rates are so high right now. So I did speak with a renter in Arlington, Virginia. He said that he had been on the house hunt. He was really looking for a starter home. He had met with a financial advisor at Rocket Money, and he said that the only thing he could really afford right now in Northern Virginia is a condo. And so he started to look for this condo, and he couldn't find it. There wasn't much that was really on the market, and if there was, it was just really out of his budget. So really pricing him out of the housing market. But then there are other renters who really just like renting, Rochelle. I spoke with a renter who lives on Long Island. She has been renting for 40 plus years. And she said, she's like, I don't want the responsibility if something happens inside the house. She doesn't want to be taking care of the damages. So she's like, I'm in the rental market forever. And she's been enjoying it so far. The other thing is that other renters really like to invest outside of real estate. Some of them are investing in the stock market or other assets for that matter. So that's some of the reasons why people are staying in the rental market. Rochelle?
It's true, and it's important to add that caveat that renting doesn't always make sense for everybody, and neither does home ownership, so you have to do what works for you. But I'm curious to know, how are landlords and private operators adapting to people staying in the rental market longer than before?
Landlords and private operators are really reaping the benefits right now, given the strong demand. If we take a look, executives at Mid-America Apartment Communities, which owns 300 apartment communities in the U.S., they said that 50% in May, they said this, 50% of their leases will be repriced between May to August. And that is for either new leases or renewal leases. So this is really signaling the strong demand in the rental market. And also, I want to point out that rents do tend to tick up during this time frame, usually in the spring and summertime. And the reason is people they take advantage of the warmer weather to move, Rochelle.
Sure, and you've got a lot of graduates moving all over the place as well. Appreciate you giving us that update, our very own Danny Romero. Well, that's it for Wealth. I'm Rochelle Akufo. Thanks for watching. But don't go away. Stay tuned for Market Domination with Julie Hyman and Josh Lipton. That's coming up at 3 p.m. Eastern. You won't want to miss it. Goodbye for now.